Welcome to the first lesson of computational investing. My assumption in terms of learning goals is that you want to be a portfolio manager. What is it you need to know and what motivates you? It depends on what type of fund you manage and what your incentives are. Your motivation is probably compensation, and your compensation depends on the type of fund you manage and how well your fund performs. As I mentioned, we're assuming that you want to be a portfolio manager of some sort, and there are several different sorts of portfolios you might manage. So let's take a look at a few of those. There are many different types of funds, of course, but three broad classes that we'll take a look at are ETFs, or exchange-traded funds, mutual funds, and hedge funds. Let's look at the differences between these. ETFs, or exchange-traded funds, are very much like stocks in the sense that you can buy and sell them, you can observe their prices intraday, you can trade them just like stocks on a stock exchange. They represent baskets of stocks. Sometimes they represent other instruments like bonds and so on, but it's very well known and they publish what it is they're holding. Accordingly, ETFs are very transparent and they're very liquid. Mutual funds are somewhat similar to ETFs in the sense that they have a declared goal or mechanism. In other words, they're, for instance, trying to track the S&P 500 or some other such goal, but they're a little bit different. First of all, you can only buy or sell mutual funds at the end of the day. So at the end of the day, they add up all the things they hold and compute a net asset value, and that's the value at which you can buy or sell shares of a mutual fund. They don't disclose exactly what they're holding except once every quarter, so they're accordingly less transparent. They're less transparent because since their last disclosure, you don't know exactly what they might have bought or sold. Still, they're somewhat transparent because they have stated goals and you know what they're trying to achieve. Similar to, say, an ETF that might represent the S&P 500, there are also mutual funds that represent large cap stocks like the S&P 500. Hedge funds are even less transparent than mutual funds. In fact, even to buy shares in a hedge fund, you have to enter into an agreement that is usually secret in the sense that you're not supposed to reveal the contents of that agreement. It's hard to exit a hedge fund. They usually require you to put your money in and leave it there for some number of months, sometimes years. And when you take it out, you can't necessarily take it out all at once. Hedge funds don't ever have to disclose what they're holding, not even to the investors in the hedge funds. Now, that might dissuade you from wanting, say, to invest in it if you don't know what they're holding. On the other hand, if they show you good performance, you might want to invest. They will usually describe to clients what their strategy is and so on to encourage clients to invest. Accordingly, hedge funds are not transparent at all. I mentioned a couple words while I was describing these different kinds of funds that I wanted to touch on real quickly. I said liquid a couple times. What that means is the ease with which one can buy or sell shares in a particular holding. Stocks are extremely liquid. ETFs are liquid in the same way. In other words, you can go to a stock exchange, you can buy an ETF and sell an ETF. It's priced just like a stock, but when you buy it, you're buying shares of multiple stocks instead of just a single stock. But ETFs are liquid because they're easy to trade. They're also liquid in many cases because there is so much dollar value trading in them each day. If you look up an ETF on, say, Google Finance or Yahoo Finance, you can see how much volume is traded each day. And ETFs with higher volumes are even more liquid. I mentioned large cap. What cap means here is capitalization, or in other words, how much is the company worth according to number of shares that are outstanding times the price of the stock. So some really huge cap stocks, say like Apple, are worth many, many billions of dollars. So when I say large cap stocks, that's what I'm referring to. There's also small cap stocks that are similarly have lower value. And one thing to mention, as long as we're on this topic, is the price of a stock really only relates to what one share is selling at. It doesn't relate to the overall value of the company. We'll get into all these topics a little bit later. Now, to recap, there are at least these three types of funds. There are electronically traded funds, which you can trade like stocks on a stock market. There's mutual funds that are a little bit harder to get in and out of, but you can trade them on a daily basis. You usually have to go through a specific broker. You can't just trade them on your own. And finally, hedge funds require a specific agreement to trade into or out of. Okay, those are the three major types of funds. I want you to fire up your web browser and do a little bit of research. Take a look at either Yahoo Finance or Google Finance, and you'll find the answer to this question. I want you to look at each of these 5 funds and determine, is it a ETF, a mutual fund, or a hedge fund? And fill in the text in each of these little boxes with an E if it's an ETF, an M if it's a mutual fund, and an H if it's a hedge fund. Again, E, M, or H. Now, as you might have discovered, these 4 or 5 letter symbols represent particular funds. So VTINX is a mutual fund. DSUM is an ETF. FAGIX is another mutual fund. You probably discovered that Bridgewater Pure Alpha doesn't have one of these symbols, and that's because it's a hedge fund. These guys have symbols, these short several letter abbreviations, so that they can trade more easily on exchanges that have hundreds and thousands of different assets that are being traded. Whereas when you go to engage with a hedge fund, it's just a one-on-one relationship. Hedge funds typically have no more than 100 investors, whereas all these other types of symbols have thousands and maybe even millions of investors. Finally, SPLV is an ETF. A couple other things to mention. It's fairly common practice that mutual funds have 5 letters and ETFs have 4 or 3. Again, you can see this mutual fund has 5 letters, and this is another ETF with 4 letters. Okay, on to more fun. We talked already about some of the differences between exchange-traded funds, mutual funds, and hedge funds. And those differences that we talked about are primarily having to do with how they're traded and how visible what they're holding is to those who invest. Another very, very important sort of difference is how are the managers of these funds compensated? In other words, there's some sort of rule for each one that shows how the fund managers make money. And that's very, very important because the manner in which they're paid incentivizes them to trade or act in certain ways. So let's talk about each one of these individually. Before I get started, though, I have to introduce one concept here. It's called Assets Under Management, or AUM. And this is a buzzword that simply means how much money is being managed by the fund. It's important because for all of these, part of the compensation is a percentage of the AUM. The managers of ETFs are compensated according to an expense ratio, which is simply some percentage of AUM. Expense ratios for ETFs are usually pretty low. They vary from as low as 0.01% or 1 BIP, as that might be called, to as high as 1%. But one that's up to 1% is fairly high and pretty unusual. Mutual fund managers are also compensated using an expense ratio. These are somewhat higher than ETFs. They range from a low of typically about 0.5% to some that are very high up to 3%. Now, what's the reason for this difference? Well, mutual fund managers will tell you that the way they manage funds requires much more skill. They have much more discretion than those who are managing ETFs. ETFs usually are tied to an index. As an example, a popular ETF, SPY, is supposed to track the S&P 500. And all that an ETF manager has to do in that case is just make sure that they are holding all the stocks in the S&P 500. Mutual funds, on the other hand, supposedly use more skill, and therefore they can charge a higher expense ratio, both for the costs of their research and also for their skill. Finally, hedge funds are a completely different breed in terms of how their managers are compensated. They follow an old model called 2 and 20, which means 2% of AUM plus 20% of the profits. So as you can see, it's higher than both of these other methods. And most importantly, it includes this component relating to profits, that 20%. Now, one or two other things to clarify here. What I've been talking about is the way that the folks who manage these funds are compensated. Separately, if you are an investor in one of these funds, in other words, you give your money to one of these types of funds to be managed, your return is based on how much the value of that fund increases. And in most cases, that increase is subject to what happens to the economy or what happens in the markets. Let's look at a more detailed example of this 2 and 20 structure. Consider this example for the 2 and 20 situation. Assume you're a hedge fund manager and that you've been managing a fund of $100 million, and that over the course of a year, your skill has resulted in an increase in value of that fund by 15%. So over that year, the fund grew in value from $100 million to $115 million. What would your compensation be? So it's 2% of AUM plus 20% of the profit. The 2 component works out to be $2 million. The 20 component is 20% of the $15 million profit we made, which is $3 million. So total compensation for this year for the hedge fund manager would be about $5 million. Now, one question that some people might have is, hey, is this 2 component 2% of 100 million or 2% of 115? And it depends on the hedge fund, of course, and depends on when they take snapshots to do accounting. The full answer is probably it's going to be a blend somewhere between 100 million and 115 million. This structure 2 and 20 has been assailed lately, and it's very rare now to find a hedge fund that offers rates that high. They're much lower now, 1 and 10, things like that. So the 2 and 20 was in the heyday of hedge funds in the 90s and early 2000s. Nowadays are typically a little bit lower. There are some star hedge funds that charge more. For instance, SAC Capital, which is no longer operating to the public anyways, that charge as much as 40%. So it was 4 and 40. However, most hedge funds you find today will be somewhere between 2 and 20 or lower. I want you now to think a little bit about these incentives that we talked about. I want you to think about if you're a fund manager and you had one of these incentives, what would it incentivize you to do? So, for instance, think about making profits. If you believe that an expense ratio compensation structure more strongly motivates profits, then click there. If you think 2 and 20 is a stronger motivation, click there. Now, it's okay if you think it's about equal or there's no difference for you to click both. Give it a go. With regard to accumulating assets under management, the expense ratio approach really most strongly motivates that, although I wouldn't count too much off if you also clicked 2 and 20, because of course the 2 part of 2 and 20 is assets under management. But if you were strictly driven by expense ratio you're going to be applying most of your energy towards accumulating assets so that you'll have a higher return. In other words, as a portfolio manager, you'll get more money. Profits are different. ETFs and mutual fund managers are not compensated for making profit, especially when you consider, say, ETFs, exchange-traded funds. They're just supposed to track a particular asset or index, and they should be good at that. It's not up to them whether that index goes up or down. So 2 and 20 is the structure that most compensates for profit because it has this 20 component that is indeed part of that profit. With regard to risk-taking, a expense ratio based fund really is not incentivized to take risks at all. If they take risks, there's no compensation for it. Under the 2 and 20 model, though, they are incentivized to take risks because that's how they can get to profits. Also, because they're always going to get this 2%, even if they take huge risks and don't make a profit, they're always going to get that 2%. So they're incentivized to take a risk because A, there's not too much of a penalty, and B, if they take a risk and make profits, then they'll be compensated more. From here on out, I'm going to assume that you want to be a hedge fund manager. And one of your first tasks as a hedge fund manager is to get investors. So who might your investors be? There are 3 major types of investors in hedge funds. Of course, there's others besides these, but these are the 3 main types. Individuals, in other words, a single person that wants to invest in a fund. Of course, these are typically very wealthy folks. Keep in mind that hedge funds typically can only have up to 100 investors. So they want each of those investments to be fairly large so that they can manage, of course, a significant amount of funds. So the individuals who invest in hedge funds are typically, as I said, very wealthy. Institutions. What do I mean by institution? These are things like very large retirement funds, like CalPERS out in California. These are university foundations, like the Harvard University Foundation or the Georgia Tech Foundation. In other words, institutions, very often nonprofit institutions, that have a large sum of money that they need to keep somewhere. And of course, they'd like to see an accrual in value, so that's one reason they look to hedge funds. And finally, funds of funds. What funds of funds do is they group together the funds of many individuals or institutions. So, for instance, you might be an individual that could, say, invest in one hedge fund, but you'd really like to get the advantage of investing in several funds. So you might allow your money to be collected by a manager of funds, and then that manager would gather together all these assets and pick carefully several hedge funds to invest that money in. So besides knowing who your investors might be, it's critically important to know why they might invest in your fund. How can you present the case to them that will convince them that they should let you manage their money? Here are at least some of the criteria that folks like this would consider before investing in a hedge fund. Track record. So if your fund has a great track record, that's of course some of the best evidence that it's going to continue to work well. Many institutional investors will want to see a good track record for at least 5 years before they'll invest in a particular fund. Now, if you're a young whippersnapper hedge fund manager and you don't have 5 years yet, what are you going to do? Well, what you can do is simulate or backtest your strategy. And investors will consider these simulations, but that simulation has to be backed by a very compelling story describing that strategy. In other words, you've got to have a reason for why this method works, and it needs to make sense. And finally, they consider how your strategy fits within their portfolio. In other words, if your strategy is for large cap S&P 500 stocks, and they've already got that covered with another fund, they might not consider you. However, if you, for instance, are looking at small cap growth stocks and they don't yet have that part of their portfolio filled, they'll give you some more thought. So when an investor is considering a particular hedge fund, they want to know what are the goals for the hedge fund, and they'll also want to know the results of certain metrics. Let's take a look at goals first. Now you might say, of course my goal is to make money. Well, it's a little bit finer than that, or a little bit more subtle than that. There are of course other potential goals, but these two are the primary types of goals that hedge funds go after. One type is to beat a benchmark. What does that mean? Let's suppose, for instance, that you've got a strategy that looks at the stocks that are in the S&P 500. There's 500 of them, of course. And you're especially smart at picking out the good ones. So you might build a hedge fund whose goal is to beat the S&P 500 index as a benchmark because you're wise at selecting among all those which stocks are going to outperform. And of course the overall index has the good stocks and the bad stocks, so you're going to do better because you picked the specific good ones. An important component of the beat a benchmark model is that many benchmarks, like the stock market as a whole, for which S&P 500 is a good representative, go down. And it is, of course, natural that a portfolio consisted of stocks from this index might go down as well. So even though both the index and the fund go down, you can outperform the index by going down less. So this kind of fund that is tagged against a benchmark can still meet performance goals if it goes down, so long as that index is going down more. That brings us to absolute return funds. Their goal is to provide positive return no matter what. These funds are usually long-short, which means they make positive bets in stocks they think are going to go up, and they make negative bets in stocks that are going to go down. We'll talk about shorting a little bit later. In any case, their objective is to make slow, gradual, positive return no matter what. Often, these types of funds don't make the same percentage gains as the beta benchmark fund, but they have very low drawdowns. In other words, when the market takes a big hit, they often don't. The next question is, well, how do we measure how well that fund is meeting those goals? We talked about these metrics in the mini course Manipulating Financial Data in Python, but we'll repeat it just a little bit here to remind you, and also to bring those folks up to speed who didn't necessarily have that previous course. Cumulative return is a measure of, given the amount of funds I started with, how much more did I end up with after a certain period of time. So suppose we have an ND array of values of our portfolio, where 0 is the first value and -1 is the very last one. We can easily compute cumulative return by dividing that last value by the first value and subtracting 1. So for instance, if we made 20% over a year, this would end up being 0.2. Volatility is a measure of how rapidly and aggressively the portfolio goes up and down in value, and of course lower volatility is better. Volatility is simply measured as the standard deviation of daily returns. Our last factor here, which is a measure of the ratio of risk to reward, is typically measured using Sharpe ratio, and the Sharpe ratio is calculated like this. Sharpe ratio is also sometimes called risk-adjusted reward. So you can consider that to be reward divided by risk. Our reward is our average daily return minus the risk-free rate, and our risk is simply a measure of that standard deviation of daily returns, or volatility. We multiply that ratio by the square root of 252. That is how many trading days there are in a year. And remember, we're always working with daily returns, so that's why we use this 252 number. So recapping, hedge funds have goals, typically either to beat a particular benchmark or to gain absolute return, and then metrics by which we judge how well they accomplish those goals. So cumulative return, how much did they make over a period of time? Volatility, how volatile were they over that time? And then risk-adjusted reward or Sharpe ratio. One thing I want to mention before I leave this topic with regard to benchmarks is the benchmark you choose should depend on the expertise you have. So let's suppose you're an expert in Eastern Europe and you're great at picking stocks in emerging markets in Eastern Europe. You should select some benchmark that represents that similar kind of investing. And there are indexes that represent emerging markets in Eastern Europe. There are also other funds whose values you might use as a benchmark. Or let's say your expertise is in banks. You might choose an index for the banking industry and show that you can beat that. Hedge funds are among the most computationally demanding environments I know of. They have infrastructure requirements like huge databases, significant network connectivity, low latency and high bandwidth connectivity, real-time processing, and so on. I want to show you as an example the typical kinds of computing that goes on inside a hedge fund to motivate you for this class. In other words, this isn't exactly the way all hedge funds work, but this is just to give you a taste for how many hedge funds work. And you'll see, I think, that computing and computational capabilities are core here. So we're going to work backwards from the market back towards the sort of back office of the hedge fund. The way things work are we have a certain portfolio that is which stocks we have and whether we're in positive or negative positions with regard to them. The trading algorithm here is central. It's interacting with the market, observing the live portfolio, and what it's trying to do is to get this live portfolio to match some target portfolio. So somewhere further back inside the hedge fund, we've decided what this target portfolio ought to look like. In other words, how many shares of Apple, how many shares of Delta Airlines we should have, and so on. And this trading algorithm is trying to get us there. So it's comparing target with live, and then to move this portfolio towards that target, it's issuing orders. So it sends orders like buy 200 shares of Apple to the market. Those orders get executed or not, and that updates the live portfolio. Now, one reason this kind of trading algorithm is important is you don't want to execute everything at once. In other words, suppose we wanted to take a very, very large position in Apple. If we were just to send an order, hey, buy me 10 million shares of Apple, that would affect us detrimentally in the sense that the price for Apple would probably rise and we would not get a good execution. So this trading algorithm takes those sorts of things into consideration as it moves our live portfolio to be more close to the target portfolio. In fact, sometimes it takes days to enter a particular position. So this doesn't necessarily happen all at once. And there's many, many different types of trading algorithms that have been invented to solve these problems. Now, let's step one step back into the computing of a hedge fund and look at how we arrive at this target portfolio. Here's that target portfolio, and here is some of the data and computing that could go into computing that target portfolio. So from somewhere, machine learning perhaps, we have a forecast of what stock prices are going to be at some time into the future, and that can, of course, drive what our target portfolio ought to be for today. In other words, if we're forecasting that BAC is going to go up, this might represent that we think it's going to go up 5%, we might want to increase our holdings in that. If we think that Apple, for instance, is going to go down, we might want to decrease our holdings. So this forecast informs this algorithm called a portfolio optimizer that works to balance the risks and rewards for a balanced portfolio that considers volatility and correlation between different stocks and so on. We're going to talk a lot about portfolio optimization later in this course. Some other considerations that go into Portfolio Optimizer are historical data, open, high, low, close, and volume. We can look at that historical data to inform how stocks are correlated or uncorrelated to one another. And also of critical importance is our current portfolio. It may be the case that if we're holding something, we don't want to exit it immediately because we'd be penalized by rapidly selling it. So this optimizer takes all this information into account to get to the target portfolio that our trading algorithm is working to drive us towards. Now, one more stop along our road here at the computing infrastructure of a hedge fund is to look at how do we come up with this in-day forecast. By in might be 5 days or 10 days or whatever. So here's this in-day forecast, and we've got some kind of forecasting algorithm. This is very often in the form of a model, in fact, a machine learning-based model. And creating these sorts of forecasting algorithms using machine learning is a focus of the last mini course in this group of mini courses. Anyhow, how do we get to this forecast? Well, we've usually got some sort of proprietary information, again, historical data, and our forecaster crunches all that data to build a model and create a forecast. So, bringing it all together, that's the computing in a hedge fund, and we've also spent some time talking about what might motivate you as a hedge fund manager. That's it for this lesson. I'll talk to you again soon. You may have experience trading stocks over the internet using a platform like E-Trade, Interactive Brokers, or another online broker. What happens when you click Buy? It's probably a lot more complicated than you think. The way that you build a portfolio or buy stocks that you hold in your portfolio is by issuing orders. Usually you send those orders to a stockbroker and they take care of executing them for you. We're going to dive now into the details of what happens when you create an order and how it gets to the market and back, and how things can go wrong and how they can potentially go right. The first stop there is to think about what is actually in an order. What are the components of an order that can go to a stock exchange? Here is all the information that must go into a well-formed order. First of all, we need to know, are you looking to buy or sell shares of a stock? Next is the symbol. This is an identifier for the stock or perhaps ETF that you want to buy or sell. For instance, IBM or SPLV. Next, you need to tell your broker how many shares you want to buy or sell. Stocks and ETFs and other assets are sold in units of shares, not by amount of money. So you don't tell your broker, I want $100,000 worth of Apple. You tell your broker, I want 1,000 shares of Apple. Next, you need to tell your broker whether this is a limit order or a market order. Let's start with market first. Market means you're willing to accept a good price, but essentially whatever price the market is currently bearing. And I'm going to show you in a moment how that's determined. A limit price means you don't want to do any worse than a certain price. For instance, suppose you're selling some stock. You might specify, I don't want it to be sold below a particular price. Or if you're buying stock, you might say, I don't want to pay more than a certain amount to get it. If you're issuing a limit order, then you have to say what the corresponding price is. If it's a market order, you're not able to specify that price because essentially when you issue the market order, you're saying, I'll take whatever price comes back. Let's take a look at a couple example orders. Here's one. Buy IBM 100 shares, limit $99.95. So this means I want to buy 100 shares of IBM at no more than $99.95. Another example, sell Google 150 shares, market. Notice there's no price with this because we're going to take whatever the market price is. So let's look at what happens when these orders reach the exchange. A key construct at most exchanges is something called the order book. Each exchange keeps an order book for every stock that they buy or sell. And here's how it works. Let's suppose you've just issued an order to buy 100 shares of IBM with a limit price of $99.95. And let's suppose for the moment that this arrives at the New York Stock Exchange, and so far today, nobody's put in any orders. So your order is the first one, and they'll use it as the basis to start building their order book. So yours is the first entry in the order book, and it simply shows somebody has bid $99.95 for 100 shares of stock. And this is public knowledge. People can view this and see, okay, there's interest in buying shares of this stock. Now, they don't know who has made this bid. The exchange knows that it's you that's made that bid, but they see that there's interest in 100 shares. Now, others may send in orders like yours, and this number just keeps getting larger depending on how many orders come in. When this is displayed publicly, people just see that, okay, there's interest maybe from various people in 1,000 shares of IBM at $99.95. So far, nothing's been bought or sold yet, though, because we don't have anybody willing to sell. Well, let's suppose a sell order comes in. Sell IBM, 1,000 shares, limit of $100. Well, there's nobody willing to buy 1,000 shares at $100, so the exchange again is going to have to add this order to its order book. And this will be our first ask. We've got now our first ask as part of our order book. Now let's say more and more orders come in and it fleshes out our order book a bit. Here's our order book as it's fleshed out a bit as orders have come in. We've got a number of asks, which are requests to sell stocks, and a number of bids, which are requests to buy. Suppose now we get a market order to buy 100 shares of stock. Here's our new order, and here's what happens. The exchange looks at its order book, and it sees, yes, we have lots of shares for sale here. We have to give the client the lowest price, so we'll give that client 100 shares of these that are priced at $100. So that means now we've only got 900 left here. We take that 100, give that to the client who put in the order, and this is the state now of our order book after that transaction. Consider this order book now for a moment. Look at how many shares we have for sale and how many shares people want to buy. Do you think the price of the stock in the next few minutes, assuming this order book, is the price going to go up or down? Check the box that you think is correct. The correct answer is that the stock is probably going to go down in price because there's much more selling pressure. Imagine for a moment if we put in two market orders. Suppose there was a market order to sell 500 shares. What would happen? Boom, you would sell 100 at $99.95, 50 at $99.90, and so on. Price would immediately go down. Consider, on the other hand, if somebody put in a market order to buy 500 shares, well, the price wouldn't budge. You would just get 500 of these 1,000 for sale, but the price would still remain between $100 and $99.95. I'll explain that a little bit more as we provide some specific examples on what happens to the order book as different orders come in. Okay, so to understand better how the order book works and how exchanges work, let's look at a couple more example orders. For brevity, I'm leaving out the symbol IBM. This is all about IBM, so just keep that in mind. Okay, so a market order comes in to buy 100 shares at market. So again, we see that there's 1,000 shares that people are willing to sell, and the exchange has to give the best price to the client, and so we would give the client 100 shares at this price. So what happens? The order comes in, 100 shares go away, and now the order book is changed just so that there's 900 shares available here now instead of 1,000. And the execution price is $100. Let's consider now a limit order. Someone wants to buy again 100 shares at a limit of 102 cents. So looking at the order book, again, we can satisfy that order and again at $100. So we're saying that we want to pay no more than $100.02. So again, we can execute at 100, and now this goes down to 800 shares instead of 900 being available. And the execution price for this transaction, again, is $100. And note also that that's less than that limit price of $100.02. Let's look now at one last order, a market order, where someone wants to sell 175 shares. So that comes in, and we have 100 shares available at $99.95. So those get sold, and there's none left there at that price. So 100 shares get executed at $99.95. So to get this 75 more shares, we need to go deeper into the book. So we'll take these 50, 0 left there. We still need 25 more shares to meet this order for 175, so we go even deeper into the book and take some of these. So after all these transactions, the order book has been changed quite substantially, and this client gets 100 shares at $99.95, 50 at $99.90, and 25 at $99.05. So altogether, there's some average price at which this was executed for that client. Note now that as time has gone on, the executed prices have been decreasing. Clearly, we're seeing that that's a consequence of there's much more sell pressure than buy pressure. So that's how the order book works and how exchanges use order books to facilitate transactions between their clients. This is what an order book looks like in real life. Here in the middle we have prices, and on either side here we see the order sizes. We're seeing here sell orders and how large they are, and on this other side buy orders and how large they are, and the prices that they're being executed here are in the middle. And as you can see, it's changing dynamically and rapidly as trades are executed. Here we see a price chart showing how the prices is going up and down as these trades are being executed. So that's a live order book. This is using the trading platform called Thinkorswim. We've talked about what orders are, and we've talked about what happens to them when they get to the exchange. Let's talk now about how do the orders get to the exchange from you. Well, here you are with your laptop connected to the internet, and you've just entered an order to buy some stock. Your buy order goes over the internet to your broker. Your broker, in turn, is connected to several exchanges, and the broker determines where to route your order based on information it knows about the exchanges. Let's suppose the exchanges we're looking at are New York Stock Exchange, NASDAQ, and BATS. For the stock that you want to buy, each one of these exchanges has its own order book. Your broker has a computer located at each exchange, and it queries that computer, say, hey, look at the order book, tell me what the prices are there. Queries that at all the exchanges. Your broker gathers and examines that information, and based on that, routes your order to the exchange that has the best price. Let's say that's New York Stock Exchange. Your order enters the exchange, gets executed, and the price comes back to your broker and forwarded back to you, and you get a confirmation. Now, it turns out that because this is happening constantly all the time, there's multiple brokers, hundreds of thousands, millions of people making orders, that the order books at each of these exchanges tends to be pretty similar. In other words, the prices don't differ much between one or another. And it's this sort of pressure that keeps prices the same across these different exchanges. Let's consider another scenario. Suppose there's another client of this same brokerage, Joe, and that Joe wants to sell some stock. Well, the brokerage can observe, hey, I've got some clients who want to sell, some clients who want to buy. I can just make that exchange internally, and I don't even need to go to the exchanges. This can be advantageous for the broker because the broker doesn't have to pay now fees to the exchanges for this transaction to occur. However, according to the law, both the seller and the buyer have to get prices that are at least as good as they would have gotten if they had gone to an exchange. And eventually, at the end of the day, this transaction has to be registered with one of the exchanges. Usually it's recorded at the exchange where that particular stock is homed. Let's consider one more example. In this case, Lisa also wants to sell some stock, but she uses a different broker than you do. There's one more kind of entity out there called a dark pool that acts as an intermediary between brokerages and exchanges. So the dark pool is looking at the order books of the various exchanges, and they're often making predictions about which direction stocks are going to go. They actually pay the brokers for the privilege to look at the orders before they go to the exchanges, and if they see an advantageous trade, they'll go ahead and take it. So in this case, this sell might be routed through the dark pool from broker 2 through to broker 1, and again, the transaction never makes it to the exchanges. In fact, these days, 80 to 90% of what they call retail traders' orders never make it to the exchanges. They're either executed internally within a brokerage or filled using a dark pool. The brokerages and the dark pools argue that that's just fine because both partners in this transaction are getting prices at least as good as they would get at the exchanges and on the order books, but they're saving money because they don't have to pay the exchange fees. We've talked so far about how exchanges work and how the order book facilitates transactions at the exchanges, and we've talked about how orders get to exchanges or not. Now let's take a look at how hedge funds can exploit inefficiencies in this system. Okay, let's suppose you live in Seattle and you want to make an order. You look at the prices on your computer. You see what you think looks like the prices are going to go up, so you enter a buy order. Now, your order travels all the way across the country, and because you use E-Trade, it stops in Atlanta, and then it hops to New York City. Let's now zoom in and see what's happening at the exchange in New York City. So we've zoomed into the New York Stock Exchange, and the order book there is visible to you over in Seattle, but also to computers that are co-located. So let's suppose our hedge fund has a co-located computer and it's observing the order book as well. Now here's the advantage that this co-located hedge fund has. Its computer is located maybe 100 meters away from the main exchange computer that holds the order book. So that 100 meters amounts to 0.3 microseconds in terms of how long it takes information about the order book to reach that hedge fund computer. You, on the other hand, are located at least 2,500 miles away. And that means when this order book changes, it takes 12 milliseconds at least for that information to get to you, and 12 milliseconds at least for your order to reach the exchange. So here's how what I call the order book exploit works. The hedge fund is continually observing the order book, and remember, it takes only 0.3 microseconds for it to do that. Based on what it sees at the order book, it thinks the price is going to go up. The hedge fund buys some of that stock based on what it sees. You're thinking the same thing, so you've entered buy, and your order starts making its way across the country. While your order is coming across the country, indeed the price is going up because other orders are coming in from other places. Eventually your order makes it to the New York Stock Exchange and is executed there, and in fact the hedge fund sells it to you. And over this few fractions of a second, the hedge fund has bought some stock, watched it go up, and sold it. It might have held this 100 shares of stock for only a few milliseconds and made a profit. And the hedge fund is exploiting essentially all these people remotely located around the country, observing the order book essentially late, sending in orders that it can take advantage of because it can act much earlier before those orders from around the country arrive. There's certainly many sorts of ways to exploit market mechanics. Here's one more. I call this one the geographic arbitrage exploit. Suppose we have exchanges located some distance away, and because they're located distantly, prices may drift a little bit up or down. Now, a hedge fund might place their own servers at each of these exchanges and connect them with an ultra-high-speed dedicated connection. And they're observing the order book, the prices at both these locations all the time and comparing notes. Let's suppose a difference emerges, that in New York, the price is a little bit lower. In London, price is a little bit higher. The fund will immediately buy in New York and sell in London. they're not necessarily even transferring those same shares. They might buy some set of shares in New York City and sell a different set in London, but they're getting that difference in price advantage immediately. Now, because hedge funds do this, because they're monitoring the prices at exchanges all over the world, these sorts of differences rarely arise, and when they do, it's just by, fractions of a cent. But those differences do arise because there are inefficiencies in the markets, and there are hedge funds there to pick those pennies up off the ground. Again, this is geographic arbitrage. Now, you may have heard of other types of orders besides just buy and sell, market and limit. It turns out, though, that the exchanges only execute these types of orders. They don't execute those other types. Well, you might wonder, okay, how do those other types of orders come into being? These other types of orders are implemented by your broker. The way that works is you enter this order type, and I'll give you a couple examples in just a second. The broker holds that order and watches the market until the conditions that you specified are met. And then when those conditions are met, the broker sends your order to the market accordingly. So here are some examples. Stop loss is a kind of order where you say, when the stock drops to a certain price, I want you to sell it. Stop gain. Similarly, when the stock reaches a certain higher price, I want you to sell it. Trailing stop is a combination of stop loss, but also an automatically changing value for when that criteria is met. So for instance, you might have this trailing stop remain, say, 10 cents behind the price. So as the price goes up, the value at which you would want to sell the stock goes up along with the price. But when it drops down below, then that stop loss is triggered. But probably the most important and most impactful kind of order the brokers implement for you is something called selling short. What selling short allows you to do is take a negative position on a stock. In other words, you sell a stock short if you believe its price is going to go down. Keep in mind here, we're selling stock we don't even own. So how is that possible? Well, again, it's possible because the broker facilitates it for you, and I'll explain how in just a minute. Okay, I'm going to step you now through the mechanics of short selling. Pay attention because it's complicated. Okay, let's imagine the following scenario. You want to take a short position in IBM, and IBM is currently selling at $100. That's the current market price. Joe holds 100 shares of IBM. He likes IBM, he wants to hold on to it, but he's willing to lend you those shares of IBM. In fact, Joe's broker will take care of that for him. He may not even know that he's lending you the shares. Let's suppose Lisa thinks that IBM is going to go up and she wants to buy IBM. So, you want to sell IBM short. You don't own any shares of it. Lisa wants to buy IBM. She thinks it's going to go up. So here's what happens. You borrow that 100 shares from Joe. Now that you have those shares, you can turn around and sell them to Lisa. And in exchange for those 100 shares that you gave Lisa, she gives you 100 times $100, or $10,000. So let me recap that. You want to sell IBM short. Joe has 100 shares of IBM. Lisa wants to buy IBM. So you borrow those 100 shares from Joe, you immediately turn around and sell them to Lisa, and you get $10,000. The result of this transaction, after everything settles, is you have $10,000 in your account, but you owe Joe 100 shares of stock. And of course, Lisa has 100 shares of stock, and so on. Now, the problem sort of arises here that Joe may decide he wants his 100 shares back. What you'll have to do is go buy them from someone and then give them back to Joe. But let's deal with that a little bit later. Let's suppose you've been watching IBM. It's reached about $100, and you'd like to short it because you think it's going to go down. Suppose you shorted it right here when its price was $100. Now you're in that short position. You watch the stock for a few days. It goes down to $90, and you decide, okay, I want to exit. So you submit an order to your broker to close out your position by buying out those 100 shares. And you do it at $90. The question is, what's your net return? Did you make money? Did you lose money? What's the total return in dollars of this transaction where you short 100 shares when it's at $100 and you buy to close when it's at $90? The answer is $1,000. For each dollar the stock drops in price, you make $100 because you've got 100 shares. So altogether the stock dropped in price $10. You had 100 shares, so your net return is $1,000. All right, let's recap what happened. You borrowed 100 shares from Joe, so that's indicated by this sort of empty box here. You sold those 100 shares to Lisa, so now you have $10,000 in your account, but you still owe Joe those 100 shares. Let's suppose that since that time, IBM has dropped in price, and now it's selling at $90. You can make a profit from that, and you want to go ahead and exit. So you approach Lisa and say, "Hey, can I buy those 100 shares back?" And she says, "No, I want to keep IBM." Well, that's a little bit of a problem, but fortunately there's lots of people who have shares of IBM and would be willing to sell them to you. So Lisa's now out of the picture and not part of this transaction anymore, but there's somebody else out there, Nate, who's got 100 shares, and he's willing to sell them. So you buy 100 shares from Nate and give them back to Joe. So your obligation to Joe is now completed. IBM was selling at $90, so you had to give Joe $9,000. But remember, you had $10,000. So the net result after everything is said and done is you've got $1,000, and you don't have any obligation any longer to Joe. So that's how short selling works. Now I personalized this story by talking about Joe and Lisa and Nate and so on. In reality, you don't have to make these personal agreements with any of these people. Your broker makes all that happen. Your broker is sitting here in between all those actors and making all this happen for you. Well, this all sounds wonderful, doesn't it? What can go wrong? Let's roll back time a little bit. Let's go back to where we had $10,000 in our account and we owed Joe 100 shares of stock. What can go wrong? What if instead of going down, IBM went up to $150 per share, and now you want to exit your position? Well, again, you go to Lisa and say, "Hey, Lisa, do you want to sell me your shares?" She says, "No." Well, Nate is still out there. He's willing to sell. So again, you buy those shares from Nate and you return them to Joe. But this time, it costs you $15,000 because the price has gone up. And remember, you've got only $10,000 in your account. So the net result after all this is said and done is that you're out $5,000. So if you bet wrong when you short a stock and the price goes up, you lose money, and it can be significant. So to recap, we've gone through many of the different aspects of the mechanics of the market. We've shown you how hedge funds exploit the market. We've shown you different order types, and we've shown you especially the details of short selling. We'll see you at the next lesson. I'd like to show you this cool machine I have. In fact, it's one of my most prized possessions that my great uncle gave to me before he passed away. Let's pretend that this machine represents a company and that I'm the CEO of that company. This company can take raw materials like this paper and process them and turn them into dollars. Here's how it works. So each year, this company can output a dollar bill reliably. What is this company worth? So think about that last segment. What is a company worth if it provides $1 every year, guaranteed every year in the future? What is that worth if you could own that company? So here are a couple potential answers. One, it's worth $1. Another, it's worth $70 because after that, I'll be dead. Not me, I'm living beyond that. Another is, well, I'm getting $1 a year forever, so it must be worth an infinity number of dollars. And finally, this company that produces $1 a year forever is worth somewhere between $10 and $25 depending on interest rates. So all of these answers are possibly correct depending on your point of view. I think this one is the most correct, and we'll be covering that in this lesson. But some of these other answers could be reasonable as well. So don't feel bad if we scored you wrong. So in a moment, we'll address how do you estimate the value of that company that generates $1 per year. In other words, that dollar bill machine. Before we dig into that, let's spend a moment considering why does it matter how much a company is worth. This course is about buying and selling stocks. So we're going to look at why company value matters with regard to buying and selling stocks. Of course, we want to buy a stock when the price is too low, and we want to sell it when it's too high. In general, the value of a company goes up monotonically. In other words, it is always increasing over time. Let's assume for a moment this is the true value of that company. We'll address in a little bit what true means, but let's assume for the moment that we have some understanding of the underlying real value of that company. Now, that true value is distinct and different from the value estimated by the market. In other words, what price the stock market says it's worth. So on one particular day, maybe the price is higher than the true value. On some other day, maybe it's lower. And on some other day, it's the same. Very many trading strategies, which is what this course is about, focus on identifying situations where the current stock price is different from the true value. So in other words, if the stock price goes up a lot, but we know the actual company is only worth a certain amount, when it goes up high, that might be a selling opportunity. In other words, if we see the price up here and we know the true value of the company is down here, sell it. And similarly, if we see the price really low compared to what the company is worth, that could represent a buying opportunity. There are many, many ways that we can estimate the true value of a company. We're going to touch on a few of them in this lesson. One is intrinsic value. This is based on the value of the company as estimated by future dividends. In other words, companies pay, many companies, not all, pay each year or each quarter a dividend. So it's a cash payment. If you own a share of stock, you get a certain amount of dividend. For instance, for Apple this year, that's about $2 per year. So intrinsic value is based on if we own one share of stock, we're going to get some amount of dividends accumulated over all of the future. What's the value of the company based on that? Another is book value, which is based on the assets that the company owns. So in other words, we add up the value of all the factories that they own and so on. Finally is market cap. This is based on the value of the stock on the market and how many shares are outstanding. So in other words, this relates to what does the market think the company is worth. This relates to what's the value of the sum of the assets. And this one relates to, well, if I own a share of stock, how much money am I going to get over the future, and what's that worth over all the future going forward. We're going to consider now the intrinsic value of our $1 machine. In other words, this machine generates $1 every year. Now, to understand that, we need to think about what is the future value of a dollar. What do I mean by that? Well, let's suppose I told you, hey, look, awesome student, I promise I will give you $1 in a year. How much would you pay me today on the basis of that promise? In other words, maybe you would pay me 80 cents, and then in a year I give you $1. Maybe you would pay me more. Think for a moment about how much you would pay me given my promise that I'll give you $1 a year from now. Okay, I want you to consider these three assets. One of them is $1 right now. In other words, I pull a dollar bill out of my pocket and I give it to you right now. Another is I, Tucker Balch, promise to give you $1 in a year. Now that's a promise you can abide by. You know, you can trust me. I'm your professor. I'm going to give you that $1 in a year. But what you need to think about is what's the value of that promise or that bond, considering that it won't happen for a year. And finally, consider this asset where the U.S. government promises to give you $1 in a year. Now I want you to rank each of these assets, a $1 bill, a United States of America bond, or a Balch promise, a Balch bond, to pay you $1 in a year. How would you rate these 1 through 3, where 1 is the best, where 3 is the worst? How would you rank these 3 assets? In other words, which would you rather have if you had to choose one or the other, where 1 is the best and 3 is the worst? So the answer is a little bit subjective, depending on how much you trust me versus the United States government. But let's start with number 1. The absolutely no question, the most valuable asset among these 3 is number 1, $1 right now, because you can take it, you can go with it, you can spend it. These other 2 are promises for a reward in the future. Now among these 2, I personally would value myself as number 2, but it's probably more correct to say that the U.S. government promise to give you $1 is the second most valuable. And then, of course, I'm number 3. It should be obvious now that the value of $1 delivered in the future, even if it comes from the U.S. government, is worth less than a real dollar right now. A real dollar right now is worth $1. If I promise to give you $1 in the future, it's not worth as much. So how should we estimate or think about the value of dollars delivered in the future? I think we've also agreed that the United States government promising to give you $1 in the future is worth a bit more than the promise of Tucker Balch giving you $1 in the future. But having a real dollar in your hand right now, this one is worth the most. Why is that? You know intuitively why that is. The deeper reason is there's a chance that I won't deliver on that guarantee, whereas we can be pretty sure the U.S. government will deliver on that guarantee. So it amounts to risk, and it all boils down to interest rate. We're trying to figure out the present value, or PV, of $1 that will be delivered in the future. So it's worth some fraction of this future value. Present value is worth some fraction of the future value. So here's the formula in its entirety. Present value is equal to future value divided by 1 plus interest rate raised to the I. So the I is how far into the future this payment is going to be delivered. So for instance, if it's going to be delivered right now, I is equal to 0, this whole component becomes 1, and present value is equal simply to future value. In other words, if we're going to pay $1, present value is worth $1. If in the future, that future is going to be 1 year from now, it's 1 plus the interest rate raised to the 1th power, and that is what the future value of that $1 is. So let's work out an example. Suppose with the United States government, because they're so trustworthy, you can negotiate a 1% interest rate. Actually, as of today, which is 2015, this 1-year interest rate is only 0.25%. In other words, interest rates are very, very low. If you work it out, the value of a $1 bill paid to you in the future, 1 year from now, at a 1% interest rate is 99 cents. In other words, today it's worthwhile for you to pay 99 cents to the U.S. government for the promise that they'll give you $1 in a year. Okay, consider now the Balch bond. So it's hard for me to sell you this asset right now for the same price as the U.S. government, because if you had to choose between me and the U.S. government for a 1% return, Why wouldn't you choose the U.S. government? You should go with the U.S. government because they're more trustworthy than I am. So how can I attract you? Well, I can offer you a higher interest rate, let's say 5%. And that works out to a value of about 95 cents. In other words, in order for me to attract you to buy my promise for $1 in the future, I could only charge you 95 cents. So let's consider this in a chart form. So how much is a dollar worth if I promise to give it to you today? Well, in that case, this I is equal to 0. So the present value is equal to the future value of all this divided by 1. So in all cases, if the number of years we're going to wait for the delivery of that dollar is 0, the value is $1. But what if we talk about promising you that dollar in the future? If we look at this for the U.S. bond, in 1 year we see it's worth 99 cents. If we carry that forward, it's sort of this exponentially decreasing value like that. If you look at the Balch bond, which is, of course, not as worthwhile as the U.S. government, you see one that decreases at an even faster rate. So in other words, at each year in the future, this $1 is worth less. In other words, if I promise to give you $1 in 2 years, it's worth less than if I promise to give you $1 in a year. It's worth even less than if I promise to give you the dollar right now. And these charts are different depending on what the interest rate is. In other words, for the higher interest rate assets, they decrease further into the future. In other words, $1 delivered in the future is worth less now than the lower interest rate assets. Think back now to our original problem. What is the present value of a future dollar, FV, delivered some number of years in the future, where I is how many years it is? And we use IR, or the interest rate, as a factor that affects this value. The analogy for this to real companies is that real companies pay dividends. In other words, if you own a share of a company, you will get some cash payment each year or each quarter. As an example, if you own 1 share of Apple stock, it pays you about $1 a year. Consider that you'll get that payment every year into the future. What is the value of that payment over time? What this interest rate relates to is how risky the company is. In other words, you're as sure that it's going to pay you that dollar every year as you are sure that the U.S. government would pay you $1 on a bond. Then this IR interest rate should be the same as the U.S. government bond rate. However, if you're less certain that this company is going to pay you at that rate, this interest rate needs to be a little bit higher. In other words, you need to expect that the company is going to pay you more in the future, or that it's going to be more likely to pay you that dollar in the future. This is called the discount rate. The discount rate is higher if you trust the company less or you think it's more risky. The discount rate is lower if it's more certain to pay you that dividend every year. Let's suppose that after considering all the factors, you feel that it's appropriate that a company should pay you a 5% interest rate considering its risks. Now, based on that, if you want to calculate what the value of the company is based on the dividends it's paying, you can take that into account in the following way. Essentially, what you want to do is compute what is the value of all the future dividends that it's going to pay me. So that's the sum of the dividend it'll pay you in a year, the dividend it'll pay you a year after that, and the year after that, and the year after that. In fact, you want to sum those all the way out to infinity. So what we're looking for is the sum of this equation, but over all I going into the future. We can draw on this infinite sum. In other words, for I equals 1 year to infinity years of the sum 1 over n to the I. So this n here is this value, and we can replace 1 here with future value. So this is not a math class. I'm just going to give you the answer. The answer is that this infinite sum, in other words, some future dollar paid each year in the future over an infinite number of years, is that value divided by n minus 1, which is equal to future value divided by discount rate. So in the case of our dollar machine, we're paying $1 each year in the future at 5% interest, so the value of our dollar machine is $20 overall. What we've just described, where future value is the dividend we're going to pay at regular intervals, and DR is discount rate, in other words, what the risk of the stock equates to in terms of an interest rate we should pay. This equation tells us the intrinsic value of the company. In other words, if we're going to pay that future value or dividend every year or every quarter going into the future, what's the value of the company on that basis? This is intrinsic value. And in the example of the company we were talking about that creates $1 every year, it's the value of the dollar in 1 year from now, next year, next year, next year, next year, continuing ad infinitum into the future, and that's $20. Let's check your knowledge now. Consider a company that pays $2 per year in dividends and a discount rate of 4%. What is the intrinsic value of this company? The answer, if you recall, is that the present value is equal to the future value divided by the discount rate. So we've got $2 divided by 4%, or $50. Answer is $50. Now, if you recall from the beginning of the lesson, we talked about 3 major ways to estimate value. One is intrinsic value, which we just covered. Another is book value, which we're going to cover now. And the other is market capitalization. So let's take a look at book value. Here's a classic definition of book value. It's total assets of the company, in other words, things like property that is owned and so on, minus intangible assets and liabilities. So intangible assets are things that are difficult to put a price on. They're things like the value of a brand or a patent or so on. Liabilities are a little bit easier to calculate. Those are just things like loans that are owed and so on. So let's consider what is the book value for an example company. Let's say the company owns 4 factories and that each of these factories is worth about $10 million. These are assets, and altogether they're worth about $40 million. Suppose this company also holds 3 very important patents, and each patent is valued at about $5 million. The value of these patents is about $15 million, but these are intangible assets that are hard to price exactly. Finally, suppose this company has 1 large loan. This would be under the liabilities column of $10 million. If we follow this rule that book value is total assets, so total assets are this $40 million plus the $15 million, or $55 million, minus intangible assets. So we just don't count these intangible assets, and liabilities. So altogether, we've got our total assets minus intangible assets, which is $40 million, and liabilities minus this $10 million. So in this case, this company's book value is $30 million. The third way of estimating company value is simply to let the market decide, and that's called market capitalization. This is a simple calculation. Market capitalization is just equal to the number of shares that are outstanding times the price. So in other words, you can look at the stock market and see what the current price is and see how many shares are owned by people, and it's just one times the other, and that's the value of the company in terms of market capitalization. If you follow the stock market, you may have noticed that when news comes out about a particular company, its stock price can change considerably. Why is that? Well, the stock price is, of course, the main mechanism by which investors can essentially let their view of the stock be known. In other words, if they think that the company is valued less, they're going to sell and the price is going to go down. If investors think the value of the company should go up, they're going to buy the stock and the price is going to go up. Now, why is it that this information or news affects the stock price? It's based on these things that we've covered up to now in the lesson. In other words, intrinsic value, book value, and, well, of course, market capitalization. But let's take a look at how it affects, say, intrinsic value. Consider a company run by this CEO and assume for the moment that his business, his company, is to grow and sell coconuts. What if the following news comes out? The CEO is ill. Maybe he has cancer, maybe he's got something else that prevents him from collecting those coconuts as effectively as he might otherwise do. Well, certainly that should affect the stock price downward, because the probability that we are going to get dividends in the future is decreasing. Either that or the amount of the dividends is going to decrease. So if you think back to the intrinsic valuation that we talked about, the potential for reduced future dividends reduces the value of the company significantly. Now consider another scenario where there's an island with our original company and another company, and news comes out about the soil on the island being contaminated. That news is going to affect not only our original company, but also all the other companies on the island. So you can think of this sort of news as being sector news. In other words, it relates to the sector of growing coconuts on this island, and it affects all the companies in the sector. Let's consider one last scenario where we have many islands with many companies on those islands and news that might affect all of them, like sea level rising. That is going to negatively impact all of these companies. So we have examples here of company-specific news that affects the price of a individual company, sector-specific news that affects, say, the companies on a particular island or in a particular industrial segment, and market-wide news that affects all the companies in the market. So that's how news can affect the prices of a stock, primarily because they reduce the expectation of future dividends. We've seen how that can affect the intrinsic value, and accordingly, why people would want to pay less for that stock. Now I want you to try to pull all this together that we've taught you so far in this lesson. I'm going to give you some specific details about a particular stock, and I want you to tell me if you would buy that stock. I'm going to give you information about the company, which has one value, and the stock, which is not necessarily the same, and I want you to tell me, would you buy that stock? We're going to break it into a few individual problems, 3 little problems, and then we're going to ask the big question. Let's start with the 3 little problems. Consider this company. It's an airline. It owns 10 airlines. Each of them is worth $10 million. It's got a brand name that's worth $10 million, and it's got a loan or liability of $20 million. All those go into the calculation of the book value. With regard to intrinsic value, it pays $1 million per year in dividends, assuming a 5% discount rate. What's that intrinsic value? Finally, I want you to compute the market capitalization, assuming there's 1 million shares outstanding and a $75 stock price. Okay, for book value, brand name doesn't count because that's an intangible asset. So we've got 10 airplanes at $10 million each. That's $100 million. And we've got a $20 million loan liability. That means the book value for this company is $80 million. Intrinsic value, we calculated that before. It's just $1 million divided by 5%. The intrinsic value then is $20 million. Finally, market capitalization. Remember, that's just the number of shares outstanding times the stock price, and in this case, that's $75 million. So let's go back to that original question. Assuming this company has a book value of $80 million, an intrinsic value of $20 million, and a market cap of $75 million. And by the way, this means that you can buy the stock, you can buy the company, the entire company, for $75 million. Our question is, would you buy this stock? And more specifically, would you buy this whole company for $75 million? Yes or no, would you buy this stock? So maybe you felt like it was a tricky question because the intrinsic value is so low. It's not tricky. Here's why. You should absolutely buy the company. You should buy the whole company for $75 million. And then you should break it apart and sell all of its individual assets for $80 million. And your net return is an immediate $5 million. This is why stocks very, very rarely go below their book value. Because if they ever go very much below their book value, a predatory buyer will buy the entire company, they'll buy all the stock, break it up, and sell it for pieces. I know that's kind of depressing, but that's the way it is. Let's wrap up this lesson. We've talked about 3 key ways to compute the value of a company. Intrinsic value, which is based on future dividends. In other words, companies pay a certain amount to their investors every year based on how many shares they own. And this is the value of all future dividends going into the future. Book value, which is the value of the company if we split it up into pieces and sold those individual pieces. And finally, market capitalization, which is simply the value that the market is placing on the company. So many stock trading strategies look for deviations between, say, intrinsic value and market cap. If intrinsic value drops significantly and the stock price, say, is high, it might be worthwhile to short that stock. Or if, say, dividends are going up and the market capitalization is low, it might be an opportunity to buy the stock. And similarly, book value provides a sort of lowest price. When stock price begins to approach book value, you can pretty much assume that the price is not going to go below book value or not much below it, because if it does, a predatory buyer would buy the whole company and break it up for parts. Anyhow, that's company valuation, and I look forward to seeing you at the next lesson. Bye-bye. In this lesson, we're going to cover one of the most significant ideas affecting finance in the last century. It explains how the market impacts individual stock prices, and it also provides a mathematical framework for hedge fund investing. It's called the Capital Asset Pricing Model, or CAPM for short. It was developed by a number of researchers independently in the 1960s. William Sharpe, Harry Markowitz, and Merton Miller jointly received the Nobel Prize for this contribution in 1990. The CAPM led to the development of index funds and the belief that you can't beat the market. Before we launch into details of the capital assets pricing model, we have to lay down a little bit of groundwork. Let's start with the definition of a portfolio. A portfolio is a weighted set of assets. So as an example, let's suppose you've got a portfolio that's got 3 different assets in it: Apple, Google, and Oracle. And if you look at the entire value of your portfolio, let's suppose that 60% of it is in Apple, 20% is in Google, and 20% is in Oracle. If we consider this as a set of weights, that means we've got 0.6 in Apple, 0.2 in Google, and 0.3 in Oracle. So the first part of our definition of a portfolio is that W sub I is the proportion of funds that are in S at I. We require that the sum of all these W sub i's is equal to 1. In other words, they add up to 100%. Now, sometimes for leveraged portfolios that we're not going to cover in this class, this number might be greater than 1, but skip that for now. We do allow that you might short some stocks. So for instance, let's suppose you shorted Google. Your allocation there would be minus 0.2. So let's refine this equation a little bit and require that the sum of the absolute values of the weights is equal to 1. So some of them might be short, some of them might be long, but if you add up the absolute value of their weights, we require that to be 1.0. So now that we've defined what a portfolio is, let's think for a moment about what will the returns on a portfolio look like. So it's a simple equation, really. It's the sum for each asset of the weight of that asset in the portfolio times the return for that day of the asset. We just add all those up one by one, and boom, that's the return on the portfolio for that day. Okay, let's suppose you've got two stocks in your portfolio, stock A and stock B, and 75% of your portfolio is in stock A, and negative 25% is in stock B. In other words, you've taken a short position in stock B. Now let's suppose on a particular day, stock A goes up 1% and stock B goes down 2%. What's the return on your portfolio if this occurs? So remember from our equation on the previous page that the return on the portfolio is the sum of each return times the respective weights added together. So the weight for stock A is 0.75 times 1%, and the weight for stock B is negative 25%. The return was negative 2% for that stock also. So because we shorted B and it went down, we got a positive component there, or 0.5, and our long on A adds up to 0.75, so our total is 1.25. So a concept that's important to the capital assets pricing model is this thing called the market portfolio. Now what is that exactly? When someone refers to the market, what they're usually referring to is an index that broadly covers a large set of stocks. In the U.S., best example of that is the S&P 500. The S&P 500 represents the 500 largest companies that are traded on exchanges, and that index changes each day according to the prices of all of its components. There's similar indexes in the United Kingdom, Japan. Any country or large market has indexes that represent this. Now these indexes are composed of many, many individual stocks, and the market portfolio is a combination of those stocks in a certain weighting. Most of the important indexes are what we call cap-weighted. And what that means is the individual weight of each stock in the portfolio is set according to that stock's market cap. So market cap, if you recall, stands for market capitalization, and it's simply the number of shares available for the stock times its price. So to calculate the weight for any particular stock, you take its market cap and divide it by the sum of the market caps of all the stocks. Now if you think back to my example of the CEO living on an island building his product, and there being many islands in an ocean, and when market forces rise or fall that affect all of the islands, you can think of these large indexes essentially as being an ocean. Now within each of these oceans, if you like, there are a number of sectors. For instance, in the U.S. we typically break the market into 10 different sectors. I list 4 of them here: energy, technology, manufacturing, finance, and so on. And these are essentially the islands. So if some malaise occurs to, say, energy stocks, you can think of that as something bad happening to the energy island. These things might be, Saudi Arabia is pumping more oil, so the cost of oil is going to go down. That usually would have a negative impact on energy, so the energy island would be negatively impacted. Same thing with these other sectors. The main point here being that positive and negative news can affect each of these sectors individually without necessarily affecting the others. So it's not unusual to break up these large markets into individual sectors. Now just recapping before we depart, when we talk about the market portfolio, in this class we're almost always talking about the S&P 500, and that market portfolio consists of 500 stocks, the largest stocks in the U.S. that are traded publicly, with a weighting set like this. One thing to keep in mind is some stocks have surprisingly large weightings. For instance, Apple and Exxon each are about 5% of the S&P 500. So those two stocks have a strong effect on what happens to this index. There are smaller stocks that comprise, say, only 0.1% of the overall effect on this market. We're finally able now to get to the core of the capital assets pricing model. And that's expressed in this single equation that's really important. You need to memorize it and understand it. And here's what that equation is. So the capital assets pricing model says that the return for an individual stock on a particular day T is equal to beta times the return on the market. So I told you just a moment ago, for instance, that when we say the market in the United States, we're usually referring to the S&P 500. And this particular stock I is one of the stocks in the S&P 500. So its return on a particular day, again, is beta times the return on the market of that day plus alpha of that particular stock on that day. So what the capital assets pricing model is asserting, and this is important, is that a significant portion of the return for a particular stock is due to the market. In other words, the market moving up or down strongly affects the change in price on every individual stock. And the extent to which the market affects a particular stock is encapsulated in this beta, which we'll talk about in just a second. But every stock has its individual beta that specifies how much it's affected. Many stocks have a beta near 1, which means when the market goes up or down 1%, that stock goes up or down 1%. But if you had, say, a larger beta, say 2, that means if the market goes up 1%, we would expect, all else being equal, that the stock goes up 2%. This other component, alpha, is called the residual. So of course, if you look at all the stocks over one day and look at how much the market goes up or down, and you calculate how much the stock should have gone up or down according to beta, well, there'll be something left over. It won't exactly match what beta predicted. And that's what this alpha or residual component is. An important part of the capital assets pricing model is that the expectation for alpha is 0. Essentially, this is a random variable with an expected value of 0. It's important to remember that. Where do we get this beta and this alpha? Well, it comes from daily returns, and essentially how the daily returns for a particular stock relate to the daily returns of the market. So look at returns here for S&P 500 and consider the S&P 500 in comparison to this other stock XYZ. So XYZ, its daily returns are shown here in green, and blue shows S&P 500. Now look at each day. Seems that the XYZ stock is more reactive. In other words, if S&P 500 goes up a little, this stock goes up more. And on average, it tends to have a higher return each day. We can look at what happens with the returns on each day and plot them over here in a scatter plot. So on this particular day, the market went up a little bit, and XYZ went up a little bit more. So that would correspond to a point right about there. Now, if we plotted the results for a lot of these days, we would get a scatter plot that looks a bit like this, where each green dot represents one day. And if we fit a line to it, we'd get something that looks about like this. So beta is simply the slope of this line. And alpha is simply this area here, in other words, the y-intercept of that line. Now this is an after-the-fact calculation. In other words, just because historically a particular stock, looking back at time, gave you a particular alpha, you shouldn't necessarily expect that in the future. And again, CAPM says that you should expect this to be 0. In reality, though, it's not always 0. So that's the key to the capital assets pricing model and where beta and alpha come from. Consider these two scatter plots. This one is for stock XYZ versus S&P 500. This one is for stock ABC versus S&P 500. And each one of these dots represents the return for S&P 500 versus ABC or XYZ for that particular day. Okay, so look at these two plots and tell me which one has higher alpha and which one has higher beta. So recall that beta is the slope of the line and alpha is where it hits the y-intercept there. So, higher alpha. Well, ABC is intersecting the y-axis there much further up than XYZ. So ABC's got higher alpha. In terms of beta, look, the slope of ABC is much higher than XYZ. So ABC also wins on the higher beta question. Now you may have heard about the debate of passive investing versus active investing. This question about passive versus active didn't really exist before the capital assets pricing model came out, and I'll explain why in just a moment. But let me just briefly tell you about passive versus active. So passive essentially says that you should just buy an index portfolio, like buy something that represents the S&P 500 and hold. Just sit on it and let it grow. Active portfolio managers don't just buy the index portfolio, they pick individual stocks. Another way you can think of this is if you compare the active manager's portfolio to the index, you'll find that he or she has higher weights for some stocks and lower weights for other stocks. Of course, those weights could be zero or even negative. But the general idea here is that the active portfolio manager's portfolio differs from the market portfolio by selecting different weights on different stocks. Let's return now to the capital asset pricing model here and consider passive versus active in that context. Both active managers and passive managers agree with this part of the equation. In other words, how the stock moves each day is most significantly influenced by the market, and that the amount that it moves is strongly related to beta. Where they differ is with regard to their treatment of alpha. The CAPM says two important things about alpha. First, it's random. You can't predict it, and the expected value is zero. Some days it'll be positive, some days it'll be negative. It may be large, it may be small, but it's random, and on average, its value is going to be zero. Active managers, on the other hand, believe they can predict alpha. In other words, they can compare two stocks and they say, I think this one is going to go up relative to the market. Remember, this alpha is market relative. Or I think this other stock is going to go down relative to the market. Now, they might not be exactly right on every single pick, but they believe on average they're better than just flipping a coin. So if you believe what active managers say, you can use information and perhaps machine learning to find stocks that have either positive or negative alpha, and you can use that information to select your stock picks. And we'll show some examples of that later on. Anyways, if you believe the capital assets pricing model, in other words, this alpha is fully random, then you should be a passive investor. Just buy an index and hold it. If you believe active managers that they can find alpha, then you should consider being an active investor. Suppose now that instead of just looking at one stock, you want to think about a portfolio. And remember that a portfolio is defined by the various weights that indicate how much of your funds you've allocated to each stock. So recall that for an individual stock, I, its return on any particular day is beta I times return on the market for that day plus alpha sub I for that particular day. So to compute the return for the entire portfolio, we compute this return for each individual stock, multiply it by the weight for that stock, and then we take the sum across all the stocks. And that's what we get for the entire portfolio. Now, if you note, we can calculate beta for the entire portfolio simply by doing this. Beta for the overall portfolio is simply a weighted sum of the individual betas for each of the stocks. So the capital assets pricing model tells us that we can simplify the expected overall return for a portfolio by computing a beta for that portfolio, multiplying it by the return on the market, and then there's some alpha. So that alpha is composed of multiple examples of this alpha, but remember, capital asset pricing model says that all of these are on average going to be 0, so we don't need to bother necessarily adding them up. We can just approximate it by an overall portfolio alpha. So again, this is what the CAPM tells us we can expect on any particular day, and again, CAPM asserts that this alpha is random with mean 0. The active portfolio manager will say, okay, yes, I agree that the beta component is the same as capital asset pricing model says, but I think I can find value in this alpha and it needs to be broken out individually. So the active portfolio manager is going to have this formulation of what they could expect in return each day compared to the CAPM, which is a little bit simpler. So I want you to consider a little bit the implications of the CAPM, and I want you to consider implications in upward markets and downward markets. So here's the question. If we're in upward markets, do you want a larger beta or a smaller beta? And if we're in downward markets, do you want a larger beta or a smaller beta? And remember, CAPM says that alpha doesn't matter. So for upward markets, we want larger beta, because that means we'll go up even more than the market if beta is greater than 1. If we have a smaller beta, that means we're not getting the full advantage of the market going up. In downward markets, we want smaller beta. So for instance, if the market goes down 1% and our beta is much less than 1, that means our portfolio will go down less than 1%. So in a downward market, the smaller the beta, the better. Let's summarize now the implications of CAPM. Let's start first with the equation. So the CAPM tells us that the expected return on our portfolio is the beta of the portfolio times the return on the market plus alpha of the portfolio. The first point, an important point, is that alpha is random and the expected value of alpha is 0. So that excludes alpha from our toolbox of ways to make money. What's left? So the only way we can beat the market now is by cleverly choosing beta, so that when the market is going up, we choose a positive beta, and when the market's going down, we choose a lower or even negative beta. So CAPM says the only way we can beat the market is with high beta in up markets and low beta in down markets. The only problem with that is the efficient markets hypothesis. We haven't covered that yet, but it's coming soon. But anyways, the efficient markets hypothesis says you can't predict the market. So these avenues are not available to you either. So all these things taken together say that you can't beat the market. If the capital assets pricing model is true, we can't beat the market. Now, I don't believe that. And this whole course is about ways that you can potentially beat the market. So we're going to get to those eventually, but we had to present the capital assets pricing model as a framework in which to consider all these other things. Now, before we close, there's one other thing I want to touch on. It's called arbitrage pricing theory. Arbitrage pricing theory was developed by Stephen Ross and first published in 1976. So Dr. Ross observed the CAPM as it was, but he said, look, we have this single beta that represents a particular stock's relationship to the market. Maybe really we ought to have multiple betas. The CAPM is really only allowing us to consider a stock in the entire ocean. And his idea, if you continue the sort of analogy we've been doing in this class, is that we ought to consider the different islands. In other words, a particular stock might have exposure to different aspects of the market. So the stock might have some exposure to finance. So we could compute the component of return due to finance by the beta with regard to finance and the return for finance of that day. So we could compute for each stock, for each sector, an individual beta. And so his assertion was that by breaking out the betas into these different factors, we could get a more accurate forecast of what the return is going to look like. And of course, we still have our alpha over here. We're not going to use APT in this class, but since we've been going forward with this analogy of oceans and islands and so on, I wanted to bring it to your attention because I thought you might find it interesting. Okay, that's it for the capital assets pricing model. I'll see you again soon. A typical hedge fund develops methods to find stocks they think will perform well. The informational edge that they're seeking is usually market relative, meaning they're looking for stocks that will go up more than the market if the market goes up, or stocks that will go down less than the market if the market goes down. If this information they have is reliable, they can take advantage of the CAPM to virtually guarantee positive return. In this lesson, I'll show you how all of that works. As an illustration of how hedge funds use CAPM, let's consider a two-stock scenario. So our hedge fund has done some research. Maybe they've used machine learning. Maybe they've used some other method. Maybe they've just thought really hard. And for whatever reason, they predict that stock A is going to go up 1% over the market in the next 10 days. And they've looked backwards in history and observed that the beta for stock A with regard to the market is 1.0. So plus 1%, beta of 1.0. They've looked at another stock, B, which they predict to go down 1%, whichever way the market goes, it'll go 1% below it. And the beta for stock B is 2.0. So this introduces for the first time this idea of a long-short portfolio. In other words, we think that stock A is going to go up, so we should long it. And we think stock B is going to go down, so we should short it. And there's some strong advantages to this long-short approach, and that'll begin to emerge as we go through this lesson. So we're going to take a look at a couple scenarios with these two stocks to see how we should best allocate between the two. So looking back, this is what the S&P 500 has been doing. Remember, stock A has a beta of 1, so it follows what the S&P 500 does pretty closely. Stock B, on the other hand, has this beta greater than 1, or 2, and so it's reacting much more wildly than stock A. Here's our first scenario. Let's assume the market stays flat. In other words, it returns 0% over these following 10 days. And that we enter our positions as of this day. And our positions are going to be a $50 long position in stock A and a $50 short position in stock B. Now assume going forward also that our predictions are perfect, that A goes up 1% over the market and B goes down 1% below the market. What will happen? Well, if our predictions were perfect, stock B should go down 1% below the market, and stock A should go up 1% above the market. What does that mean in terms of how much money we would see returned? So if we look at stock A, and remember we're using the CAPM, we should expect to see a return for A as beta of A times return on the market plus alpha. So the market didn't move at all, so this gets nullified. So alpha for A is 1%, and we invested $50 in that, so our return is 50 cents. Similarly for B, this element is removed because our return was 0, and all we're left with is alpha. Now, essentially our alpha here was negative, and we made a negative bet, so our return is 0.5, or altogether $1.0, or 1% for our total investment. I'd like you to consider another scenario now. Instead of the market staying flat, what if the market goes up 10%? I want you for stock A and stock B to compute the expected return percentage-wise, and then also in terms of dollars, and then compute the total for both down here at the bottom, or in other words, what's the return on your portfolio? Let's start by taking a look at stock A. So market went up 10%. We predicted that A would go up 1% over the market, and its beta is 1, so we should see a return of about 11%. So we get 11% here, and $5.50 here. B is a little bit more tricky. Remember, B has a beta of 2. The market went up 10%, so B is going to go up 20% minus the 1% we thought it would do relative to the market. So for B, the stock price went up 19%, but we had a negative bet there, so we get negative 19% here. So we're going to lose $9.50 on that bet. Now to compute the totals here, let's do the dollars first. So we made $5.50 on stock A, but we lost $9.50 on stock B, so altogether we lost $4. Now when you calculate the total return here, you can't just add these two up and get -8. because remember, we only had 0.5 of our allocation in each one of these. So to get the total, you multiply this return by 0.5, that return by 0.5, and you get -4. Yes, it's a little bit tricky. Let's run through one more example here, just so we get it straight. Let's assume now that the market goes down 10%. How does this all work out? Stock A should only go down 9% because we think it's going to perform 1% over the market, and its beta is 1. Stock B is going to go down 20% and minus that 1% that we think is going to go below the market. So stock B is going to go down 21%. So we're going to lose 9% or $4.50 on stock A, but we're going to really kick butt on stock B. Stock B went down 21%, but remember we shorted it. So we're going to get altogether $10.50. So altogether we're going to win $6 or 6%. What's the takeaway here? The takeaway is even if we have perfect alpha and perfect beta, if we're not careful about how we allocate our money, we can still lose. How can we fix this? The CAPM can help. Let's pull out the CAPM and take a look at this portfolio. Remember, for each individual stock, the expected return is beta times the return on the market plus alpha times the weight for that particular stock. And when we short, the weight is negative. And we do this across all the stocks in our portfolio, and then that's our expected return for the portfolio. So I'm going to expand this sum. First I'm going to start with the beta component. So we get weight A times beta A plus weight B times beta B times the return on the market. So recall the numbers from earlier. Our weights for A and B were each 0.5 and -0.5. We had a beta of 1 for A and a beta of 2 for B. For our alphas, we had plus 1% for stock A and -1% for stock B. We can plug all of these into our equation and work it out. For our beta component, we end up with a beta for the portfolio of -0.5. Our alpha component for stock A ends up just being 0.5, and for stock B, -0.5 times -1, or 0.5. So bringing it all together, under these assumptions, using the CAPM, our expected return for this allocation is -0.5 times the market return plus 1%. Let's double check this by plugging in one of our earlier examples. Consider that example where the market went up 10%. So we've got -0.5 times 10% plus 1%. So in the case where the market goes up 10%, we expect a -4% return for our portfolio. So if you step back a little bit, remember that we arrived at this 1% using information. So we have some information about these stocks that led us to believe one would go up 1% over the market, another would go down 1% over the market. On the other hand, we don't really have any knowledge about what's going to happen for the market overall. So we have no control over this component. Is there some way that we can remove this? Can we make this part equal to 0? If we can do that, then we essentially remove market risk from our portfolio and we preserve this 1% over here. Well, the way to do that is to focus on this part. Remember, this is beta for the portfolio. Can we make beta for the portfolio equal to 0? Or in other words, can we find weights for A and B such that their sum turns out to be 0? What are these two weights so that the overall portfolio beta is 0? Suppose we have two stocks, our stock A and our stock B. These are the same two stocks we've been working with. A has a beta of 1 and a alpha, our prediction, of plus 1%. B has a beta of 2 and a forecast alpha of -1%. So we want to go long on A and short on B. The question is, what should the weights be so that we can minimize or eliminate market risk? Okay, so we want to find two weights, A and B, such that when you multiply them by their betas, the sum turns out to be 0. Now keep in mind that we're going to short B, so this one needs to be negative, and we're going to long A, so this one needs to be positive. Just keep that in mind as we go forward. So let's solve for A initially here. So we know that the weight of A should be equal to minus 2 times the weight of B. We also know that the sum of A and B, well, the sum of the absolute values of A and B, should be equal to 1. If we plug this minus 2 weight of B in for weight of A, we get this. Or, long story short, the absolute value of the weight of B is equal to 1/3. So we know the weight of B has to be negative, so we get minus 1/3 for the weight of B. And coming all the way back up here, we know that the weight of A is equal to negative 2 times the weight of B. So we get this. So finally the answers are 2/3 for the weight of A, negative 1/3 for the weight of B. Okay, we've calculated these weights. Let's see how they work on the examples we've been looking at. So again, our weight for stock A is going to be 0.66, and for stock B is going to be negative 0.33. And we're going to look at the scenario where the market goes up 10%. We'll pull out our old trusty CAPM and expand it for these two stocks. So for stock A, we have the weight of stock A times its beta times the return on the market plus the alpha component. So these are the two parts that relate to the return on the market, and we'll bring them together. So for stock A, we have a weight of 0.66, and our beta is 1.0. And for stock B, we've got negative 0.33 times 2 times return on the market. So because of all that work we did to figure out these values, we know already that this is going to become 0. We'll carry down our two alpha components. So for stock A, our alpha expectation is 1%, and our weighting is 0.66. For stock B, our weighting is negative 1/3 times negative 1. Our expectation is it's going to go down 1%. So combining these two, 0.66 plus 0.33 gives us a 1% expected return. Whichever way the market goes, remember, we eliminated the return on the market. So whichever way the market goes, we can expect to get 1% return. Now, need to add a lot of caveats here. These betas aren't necessarily fully guaranteed to continue into the future, and these alphas aren't guaranteed either. These were just estimates that we computed based on information we thought we had. So this is not a guaranteed thing by any means, but it is a way to use long-short investing to reduce exposure to the market overall and to focus on those alpha components where we do have information. Let's bring it all together now, how hedge funds can use CAPM effectively. Assuming we have some sort of actionable information that we can convert into a forecast alpha, in other words, a prediction for a particular stock I about which way it's going to go, and also the beta of that stock with regard to the market, we can do the following. We can minimize market risk by finding a beta for our portfolio that's equal to 0. And we can do that by finding the appropriate weights on each individual stock. So CAPM can be a really valuable tool in terms of portfolio construction because it can enable you to build these portfolios that are less exposed to market risk. And this is where the whole idea of long-short trading came about, and CAPM really enables you to refine that. All right, that is it for now. We'll see you again soon. Thank you. There are two broad categories of approaches to use for choosing stocks to buy or sell. They're based on fundamental analysis and technical analysis. Fundamental analysis involves looking at aspects of a company in order to estimate its value. Fundamental investors typically look for situations where the price of a company is below its value. Another camp is based on technical analysis. Technicians don't care about the value of a company. Instead, they look for patterns or trends in a stock's price. This lesson will focus on technical analysis. Let's start by looking at a few characteristics of technical analysis. First, what is it? One of the most important things to remember about technical analysis is that it looks only at price and volume. That's as opposed to fundamental analysis that looks at fundamental factors like earnings, dividends, cash flow, book value, and so on. Technical analysis is price and volume only. We look back at historical price and volume to compute statistics on this time series, and these statistics are called indicators. Indicators are heuristics that may hint at a buy or sell opportunity. Now, there's significant criticism of the technical approach folks consider that it's not an appropriate method for investing because it's not considering the value of the companies. Instead, maybe you could think about it as a trading approach as opposed to an investing approach. Still, there are reasons to believe that technical analysis might have value and that it might work. First of all, there is indeed information in price and information in price change. It reflects sentiments of buyers and sellers, and especially if we see that the price for a particular stock is moving in a different direction than the overall market, that might be a hint that there's something going on. Additionally, we know that in other domains of artificial intelligence, heuristics can work, and they work frequently. So even though it's controversial, there are reasons to believe technical analysis can work. Okay, now that you know some differences between fundamental and technical factors, I want you to look at each one of these 4 factors and fill in this box T for technical or F for fundamental. So for each one, decide whether it's technical or fundamental and fill in the box. Remember that technical factors use only price or volume, whereas fundamental factors use other components. So moving average of price is only using price, so that one's technical. Percent change in volume is only using volume, and that's allowed for technical factors, so that one's technical. This one is using price. Yes, that's technical, but it's also using earnings, which is a fundamental factor. So that makes this whole thing a fundamental factor. Similarly here, intrinsic value is based on dividends, which is a fundamental. So this one is a fundamental indicator. So over the last few years, I've been using technical analysis a lot. I've also been using fundamental analysis. And people often ask me, well, when is one valuable versus the other? Let's look first at technical analysis and where it's effective. Here are some rules of thumb that I've built for myself over the last few years. First is individual indicators by themselves are weakly predictive. Now, back in the 80s and 90s when some of these were created, I believe they had stronger value. But since that time, more and more people have been trading according to them, and essentially the more people are following a particular approach, the less value is realized by any person by themselves. So individual indicators are weak. However, combining multiple indicators adds value. I see over and over again that combinations of 3 to 5 different indicators in a machine learning context provide a much stronger predictive system than just an individual indicator. Another useful approach is to look for contrasts. In other words, look for one stock that has a strongly different indicator than another stock, or a stock that is contrasting to the market. In other words, if all stocks are behaving in the same way as the market, there's no reason to pick any one stock over another. But if you see certain stocks are behaving differently than the market, then they are worth a further look. Finally, technical analysis generally works better over shorter time periods than longer time periods. To understand the value of technical analysis versus fundamental, it's valuable to consider the trading horizon. In other words, when you buy a stock and then sell it, what's the time period between those two activities? So it can be milliseconds, maybe even smaller time periods. It can be days, or it can be years. So, for instance, Warren Buffett often buys and holds stocks for years. High-frequency traders are trading on the order of milliseconds. So to illustrate what I mean, consider fundamental factors. If we are trading over a time period of milliseconds, how much do fundamental factors contribute to the change in price over those short periods of time? When we're trading machines on the stock exchange, what really matters is what's happening there on the stock exchange. For instance, the order book or momentum and so on. So at these short time periods, fundamental factors really have low value. Now consider all the way out to years. We know from, for instance, Warren Buffett's success that fundamental factors over long periods of time may have significant value. What about days? Well, maybe over a period of days, fundamental factors do have value. So imagine that we sort of chart it like this. Over long periods of time, fundamental factors provide a lot of value. Consider the same sort of chart now, but for technical factors. Let's start out over here over many years. Think about if we make a technical analysis of a stock, what its 20-day momentum is, which we'll talk about in a moment. How much is that really going to affect the price of a stock years later? Very little. So over long terms, technical analysis is not so valuable. Think back now, though, to very, very short periods of time. This is where technical analysis can shine, and it potentially has high value over very short periods of time. So we have a chart that looks a lot like the fundamental chart, but it's swapped. Let's consider a couple other factors. I won't draw the charts like these, but just think about these. So consider, for instance, decision complexity. How complex is the decision to buy or sell a stock if you're going to hold it for years? It becomes more complex out this way. How about decision speed? How fast do the decisions have to be made? Well, certainly we have to be able to make the decisions really, really fast if we're trading at the millisecond level. And of course, we can take a long time to make a decision if we're going to buy and hold for years. So as you look across this spectrum, consider where is the best region for humans to operate and where is the best region for computers to operate? Well, because at this very high frequency, the complexity of decisions is simple, computers can make those decisions very, very fast. And that also happens to be where technical analysis has value, which is the domain of the computer. So computers excel in this region of the chart. Over here, where we can take a long time to make a decision and the decisions are complex, this is the best region for human investors. So if you look at, say, different types of hedge funds, the high-frequency trading, computer-driven hedge funds are operating over here. The insight-driven, human-based hedge funds are operating over here. And then there's this region in the middle where we often see humans and computers working together. There are hundreds of technical indicators out there. We're going to take a look at just 3 because, of course, our time is limited, but I'll point you to resources online where you can learn more about other indicators. These 3 are some of the most common and most popular that people use. The 3 we'll look at are momentum, simple moving average, and Bollinger Bands. Let's take a look first at momentum. Momentum is really one of the simplest indicators, and it's just over some number of days how much has the price changed. So for instance, if we look at this point to this point, we've got positive momentum, or if we were to look from here to here, we've got negative momentum. And the steepness of that line is the strength of the momentum, either positive or negative. Now, in terms of using this in a trading strategy, there are many folks who look at the momentum for a stock, the recent momentum, and if it's positive, they buy because they anticipate that the momentum is going to continue. Now, I'm not necessarily recommending that to you. I'm just telling you how some people use it. Now, I'm going to show you in a later slide how we can use momentum as part of a combined strategy. Now, you can see here how we can look at momentum visually, but for machine learning, which of course we're going to get to in the next mini course, we actually need to convert these to numbers that we can use quantitatively. And of course, this course is about quantitative analysis. So there's always, for technical analysis, a graphical or visual presentation, but we need to also consider the quantitative presentation. So when we talk about momentum, we talk about how many days of momentum that is. So that might be N days, where we use N right there. So N might be a number like 5 or 10 and so on. Here's the pseudocode for how we compute momentum on a particular day. So let's suppose this is day T right here. We just take the price as of that day and we divide it by the price in days earlier and subtract 1. So this will give us a number, say 0.1 if the price has gone up 10%, or negative 0.1 if it's gone down 10%. So we'll usually see numbers in the range of, say, about minus 0.5 for a big significant 50% drop to about plus 0.5. And so on any particular day, this is how we would compute the value of this technical indicator, momentum. Our next indicator is simple moving average, or SMA. And again, it's indexed by N, which is how many days are we looking back. So if we want to calculate the value of the simple moving average for this day, we look back over N days, and this is called an N-day window. So the SMA for today is simply the average of the values over this look-back period. So it would be a value about right there. And if we carry it forward, it'll look like this. So the SMA looks essentially like a smoothed value of the price chart as it moves around. And an important thing to note is it sort of lags the movement. So as we started down here, it slowly started coming down. When we started up here, it lagged that movement upwards. There are at least two different ways that technicians use simple moving average as parts of trading strategies. The first is they look for places where the current price crosses through the simple moving average. Those tend to be important events, especially if the average is over many, many days. If you combine that with momentum, in other words, the price has strong momentum and it's crossing through that simple moving average, that can be a signal. This particular crossing where the price goes through the simple moving average doesn't really illustrate strong momentum because it just started going up. However, when you do see strong momentum crossing those lines, then again that can be a trading signal. Another way that technicians use simple moving average is as a proxy for underlying value. In other words, if you look back over a certain period of time and take that average price, that might represent the true value of the company. And if we see a large excursion from that price, we should, for instance, here and here, we should expect that the price is eventually going to come back down to that average. And so it's an arbitrage opportunity, sort of like we saw with fundamental analysis. And again, for example, there's a large excursion downward here, so this might represent a buy opportunity, and these two might represent sell opportunities because there was a strong diversion from that moving average. Now, we talked about earlier how every technical indicator has a visual presentation like I'm showing you here, but we also need a way to quantify it, to turn it into a number. The way we do that is to compare the current price with the current simple moving average and construct a ratio. So in this case, we would look for a negative value, and in these cases, we'd want to see positive values. So if we were to calculate, say, the value of the simple moving average on this day, we take the price for that day, and we compute the mean for the last N days, which is here. And remember, this is over a look-back window of N days. Divide that into the price and subtract 1. So if, for instance, the price is 10% above the simple moving average, we'd end up getting a positive 0.1. If it were 10% below, we'd get a negative 0.1. So similar to the momentum, we typically see values here ranging from, at most, minus 50% to plus 50%. Let's suppose you liked what I told you about simple moving average, and you're looking at the historical price of this stock, and you're trying to decide, okay, how much of an excursion from the simple moving average should I use as a signal for a buy or sell? So let's add our simple moving average line here. Now you might say, okay, I think if I see an excursion of, say, 1% like this, that's a meaningful excursion and I should trade based on that. So let's carry forward, and now you're getting these huge excursions all the time, and you'd be chasing it, trying to trade all the time. So clearly a fixed number is probably not the best way to go. If you look at this chart, you'll see that we've got a region of low volatility over here and high volatility over here. So John Bollinger observed that for low volatility stocks, or stocks that are currently experiencing low volatility, you probably want to use a smaller number for that trigger. And when we see high volatility, you probably want to use a larger number. Well, how can we accomplish that? Well, we can use the standard deviation. So what Bollinger suggested was, okay, let's take this simple moving average, but let's add a band above and below 2 standard deviations. And that's our measure for how strong of a deviation we want to see before we respond to it. So for instance, in this region, this smaller excursion goes outside that band, so we should take a look at it. But over here, it takes a much larger excursion to get our attention. How might we use Bollinger Bands now for trading signals? Here's a method that I've seen that is effective. So here's a rule of thumb for using Bollinger Bands that might be effective. You look for times where the price is outside one of these Bollinger Bands and when it crosses to the inside. So for instance, here we're outside and we cross to the inside. So this would be a sell signal. We've got a large excursion from the simple moving average, and we're expecting that it will retreat back to the average. And it's demonstrated that it's retreating because it's gone from outside the band back towards the moving average. Conversely, here we're moving from below the lower band back towards the simple moving average, and that would be a buy signal. So recapping, the way that people use Bollinger Bands is they look for the price to go outside the bands and then look for it to retreat back through the band, and that's verification that it's moving back towards the simple moving average. Here's how to calculate the Bollinger Band on a particular day T. So here's the price on that particular day T. We subtract the value of the simple moving average, so we're comparing these two values, and then divide by 2 times the standard deviation. So the value up here is going to be something greater than 1.0 because if it's exactly at this band, it's exactly 2 standard deviations away, so it would be a value of 1 right at the band. It's greater than 1 here. Similarly, down here, we would have a value less than -1 because the price excursion is more than 2 standard deviations below. So we typically expect to see values for this Bollinger Band calculation to be between -1 and 1. In other words, most of the time the stock is going to be between those bands, but occasionally we'll see excursions above and below those values. All right, suppose you like that whole idea that I told you about Bollinger Bands. Let's see now how well you might use it. So I've identified 4 different times here where the actual price crosses an upper or lower Bollinger Band. I want you to look at each one of those and identify here whether it's a buy signal, a sell signal, or no signal at all. Let's take a look at this first one. So we went from outside the upper band and crossed down inside it. That is a sell signal because we've gone very far from the moving average and we've validated now that we're moving back towards the moving average. So that's a sell. Here we've gone from inside to outside, and that is never a signal. It does indicate, of course, a significant excursion from the moving average, but we're looking for the validation that it comes back inside. So this is not a signal at all. Here, however, we've come back through that bottom band, and that is a buy signal. Finally, for this last one, number 4, we've gone outside the lower band and we've transitioned up inside it. That is a buy signal. So that's Bollinger Bands and how you might use them. Before we leave technical analysis, I want to bring up one more point called normalization. So take a look at these different technical indicators we created here, simple moving average, momentum, and Bollinger Bands. They have different ranges that they typically operate over. So like I said, we would expect to see values of -0.5 to +0.5 for simple moving average. For momentum, similar kind of range. Bollinger Band typically inhabits -1 to 1. If we were to plug these values into some sort of machine learner, we would have a little bit of a problem. And what would happen, and we'll have to go into the details later, but the Bollinger Band factor would tend to overwhelm these other factors and become the most important one. It might get even worse if we included a fundamental factor like PE ratio that can range from 1 all the way up to 300. The solution is something called normalization. And what normalization does is it takes each of these factors and essentially compresses them or stretches them so that they vary on average from -1 to +1. Normalization is simple. You take your original values for a particular factor, subtract the mean from all of them, and divide by the standard deviation of all of them. This will give you a normed result that on average is going to vary between -1 and 1, and it'll have a mean of 0. So remember this trick for later when we get to machine learning, or if you're working with technical indicators yourself, you may want to apply this normalization approach to the numbers you're working with. Let's wrap up technical analysis now. So to review, technical indicators are really heuristics that represent someone's interpretation or hunch of how a statistical approach to previous prices and volume might suggest future price movement. The particular examples that I've provided here are my approach. So if you go look up, for instance, on John Bollinger's website how to use Bollinger Bands, you might discover his approach is slightly different. I showed you specifically how I have found them to be useful in the past. Finally, lots of times when people get exposed to technical analysis, they get really excited and they want to run off and start trading. Well, hold your horses. There's a lot more to learn, so stick with it and we'll see you in the next lesson. Data is, of course, very important for computational investing. The core data and the primary data we will work with in this course is historical price and volume data. That's what we'll focus on in this lesson. Our first step in considering data is to think about how it's aggregated. In other words, imagine that many trades are happening on different exchanges. How is all that data combined and how is it reported back to us so that we can analyze it and use it? The finest resolution of data is called a tick. A tick represents a successful buy-sell match or a successful transaction. So let's suppose at this time there was a successful transaction. $100 was the price and 200 was the volume. So we record that here with a single point. A little bit later there was another transaction, 99.05, 100 shares. Now, something to keep in mind is each of these transactions happens at no specific time. It happens only when the buy and sell are matched. So there's no guarantee that there's going to be a trade in any particular minute or any particular hour. It just happens when it happens. Each exchange provides its own data feed regarding these transactions. So you can subscribe to these feeds and see at each tick when a transaction happens on any particular exchange. So I've added some red dots here that represent transactions that might be happening on another exchange. Note that the prices are a little bit different. The volumes, of course, might be different. All of this is happening simultaneously, and the prices at different exchanges aren't guaranteed to be exactly the same. Now, for highly liquid stocks, there may be hundreds or thousands or hundreds of thousands of transactions like these every second. So collecting and using all these ticks for all the exchanges over a long period of time would result in a lot of data, and it becomes very complex. Tick data is usually consolidated into minute-by-minute or hour-by-hour chunks. So I've drawn some boundaries here. Let's suppose those are on minute boundaries. And we collect all the data together within each minute and represent it as open, high, low, close, and volume. So the open is the first transaction within the time period. So we came in here, we had a transaction at 100, so our open value here is 100 within this time period. High, well, you look at the entire time period and see what was the highest price. Highest price here was also 100. Low was 99.05. Close is the last transaction, and that was 95.50. And volume is just the total volume during that time period. So it's 200 plus 100 plus 300, so 600 shares. So for this minute of time, we've consolidated all that information into open, high, low, close, and volume. Similarly, we go to the next minute and consolidate it in the same way. So in this next minute, our open was 99. Our close was 99.95, low was 99, high was 99.95, and our volume was 300. And we would continue throughout the day to consolidate the data at each minute like this. And depending on your data feed, this might be the result, say, for just one exchange, or it might be combined across multiple exchanges. In this course, these time boundaries are in days. So the data we'll be working with is daily data, and so we'll be looking at what is the data at the end of the day for each day. Now, all of the concepts that we teach here, you can just as easily apply at smaller time periods. It just requires more computing, faster computing, more and larger databases, and so on. So that's why we look at daily data in this course, is there's a little bit less data to work with. It's easier for you to download and work with, and so on. If you look at this data over many years, you'll see that there are a couple sudden price drops. For instance, here it goes from $300 to $75 in one day. Here it goes from $250 to $125 in one day. So those represent a 75% drop and a 50% drop, respectively. Now, surely the value of IBM did not drop that much in just one day. I want you to think about why this might have happened, and in a moment I'll give you some options that you can choose. But why might the price of IBM dropped by this significant amount over these days? Here are a few options for you to consider. Check the box that you think makes the most sense. So the correct answer is stock split. You might cry foul because I haven't told you yet what a stock split is, but don't worry, we're getting there. But just as advance warning, here's what it is. What happened on this day is that the stock was selling at 300, and if you had one share of the stock on this day, on the very next day you had 4 shares. So your total value was preserved. You still had $300 worth of IBM, just now you had, instead of 1 share, you had 4 shares. That's called a stock split. So indeed, these big price drops were caused by stock splits. Why do stocks split? The most common reason, and as far as I know, the only reason, is that the price is too high. Why is a high price a problem? Well, consider for a moment that stock may be above, say, $500 per share. People like to buy stocks in groups of 100. So that means, for instance, it would be $50,000 to buy or sell a block of 100 shares of a $500 stock. Now, of course, you can buy it in smaller blocks. That's fine. But another aspect is that options, when they're traded on stocks, are usually traded with regard to 100 shares. So options covering 100 shares of $500 stocks become suddenly very expensive and less liquid. So from the point of view of options and also individual stock shares, very high prices are a problem. Even in the case where you want to buy just 1 share of a stock, let's suppose you're setting your kid up with an account and you want to buy 1 share of Apple. Earlier this year, that would have cost you $600. So even buying 1 share of a very expensive stock can be a problem. Finally, one other issue here is if you're building a portfolio and you want to have a finely tuned proportion of each stock in your portfolio, if some of the stock prices are very high, it becomes difficult to get that fine resolution that you want. So when the prices get very, very high, what the companies do is they say, look, let's take that 1 share that's priced at $300 and break it into 4 shares at $75. So that's called a 4-for-1 split. In this case, we had a 2-for-1 split. Okay, so that's why splits happen. Now let's look at this data. Suppose you read this data into your computer and you were going to analyze it and look for trading opportunities. Well, your algorithm might discover, hey, look, here's a great shorting opportunity. Whenever this condition occurs, whatever that was, you ought to short the stock, and then you'll see a 75% drop, and you'll reap a significant reward. And also here, you might identify this time as a good opportunity to short as well. Well, of course, that's wrong, because what's happening underneath is that the value of the company isn't really decreasing. You just have more shares. So if you want to trade using this actual close data, you have to account for all of these splits, and that becomes cumbersome. So someone came up with a great solution to this problem, namely adjusted close or adjusted prices. And the idea is to create a timeline of prices that are adjusted to account for these changes, such that you can look back over adjusted close, simulate buying at a particular time, and seeing how the value increases over time accurately without having to account for these splits. Here's how it works. The first thing to point out is that at the very last day, in other words today, adjusted close and actual close are always the same. Now we track back in time, and adjusted close and actual close are exactly the same. But then on this day, when we see this 2-to-1 split, what we do is we go back over all the historical data and we divide it all by 2. So the first day before this split, we get about a $125 price instead of that $250. Then when we get to this 4-to-1 split, we divide by 2 and then by 4, so that on this one day before that split, our price is in the neighborhood of about $70. And that continues back in time, and as we go back, we adjust for each of the splits in history. So now we have a nice smooth price timeline without these big jumps. And for instance, if you considered that you bought the stock on this day and held it until this day, the accumulation in value that you see there is accurate. It reflects all those splits, and you would have a lot more shares here, but this would also correctly represent the increase in value. Consider this situation. This green line represents the actual price for a stock over time. On this day, it had a 2-for-1 split, and accordingly it went from $100 to $50 on that day. So in light of this split on this particular day, I'd like you to consider these actual closing prices and then calculate what the corresponding adjusted closing prices would be on these days. So let's start over here. Going back from today, our adjusted price is the same as the price today. So as we go back and we get to this day where there's $100 in the actual, there's no change. It's still $100 also for the adjusted. Okay, we go back further. On this day of the split, again, no change. That would have been $50. But we're looking to calculate the price just before. In other words, when the actual price was $100, just before that split, what would the adjusted close be? Well, we divide everything by 2, remember? So we would have 50 here. So we would cruise along like this. And again, here we divide by 2 because that's what our recent split was. And we would have 25 here. So this correctly represents that if you bought the stock on this day, it would double in value by the time you got to this day. And if you bought it on this day and held it all the way to here, you would actually get 4 times your value. Now, remember earlier when we were talking about stock value, or I should say company value, and we looked at a way to compute company value based on dividends. So companies pay regularly, many companies, not all, dividends to their owners. And this can be worth a lot of money. So a stock that's priced at, say, around $100 can very often pay up to $1 or $2 per year in dividends, or 1 or 2%. Some stocks pay even more than that. Now, dividends can have a significant effect on what happens to the actual price of a stock. And here's why. Suppose this stock is trading at about $100, and they announce, on this date in the future, we're going to pay a $1 dividend. So for every share of stock that you own, you'll get $1. What do you think is going to happen to the price of this stock between now and the date of that dividend? Let me give you a little bit more information that might make things simpler. Let's suppose that the consensus on the value of the company, by whatever means you've determined that consensus, is that the company is worth $100 per share. So on this date, when we get that $1 dividend, we're going to have 1 share of a company that people think is worth $100 per share, and we will have $1. So on this date, we'll have 1 share of a company supposedly worth $100 and $1. So think about it. What prices will we see this stock converge to on the day before the dividend is paid and the day the dividend is paid? So answer this as a quiz. Here, fill in what would the price of the stock be the day before the dividend, and what would the price of the stock be the day the dividend is paid, when people get $1 and they also keep that share of stock. So what's going to happen is that the stock price is going to rise to 101, because everybody knows that on the next day you're going to have one share of a stock worth $100 and $1. So the total value of that is $101. On the very next day, the price is going to drop by $1, and everybody who held a share that day will have one share of stock and $1. So their value, continues at this $101 level. So the answers are: the day before, the price we should expect to see is $101, and the day the dividend is paid, we should expect to see $100. And don't forget, you got your $1 dividend also. So here I've redrawn that same scenario. We've got the price of a stock trundling along. On this date, the dividend is announced that it'll be paid on this date. And so we see, in general, the price rising up until that date and then a strong drop. And again, the consensus value for the company is about $100. So let's consider now how we might adjust historical prices for this situation. So again, adjusted price as of today, or the latest day in our data, is always the same as the actual price. And as we go back in time, it remains about the same until we hit one of these events like a dividend or a split. So we treat historically the price in the same way we do with a split. In other words, just before the dividend is paid, we adjust all of these prices down by the proportion of the dividend. So in this case, we adjust everything down by about 1% all the way back in history. So our adjusted price continues like this. Now, to double check this for sort of rationality, consider that you bought the stock around this date and you held it all the way through the dividend payment. You would get an increase in value of your holding of about $1. So the adjustment is achieving its purpose, which is to allow us to not worry about dividends and splits, just go back in time, buy and hold the share, and see how much our value accumulates. So for the data we'll be working with in this class, which are daily close values, we have in our data both actual and adjusted. And in almost every instance, I will assume that we're using adjusted close prices in our calculations. A couple other things to reiterate about adjustments is the last day in our file, usually that's as of today, the adjusted and actual close value are the same. So any day that you look, say you got to go to Yahoo Finance or Google Finance and you get adjusted close and actual close, you'll see that today they're exactly the same price. But as you go back in time, they will begin to diverge. And the prices we use are adjusted for both dividends and splits. And it's very important that you always use adjusted close. One other thing to mention is suppose we had this data as of 2012. And so this last date here in our file is some date in 2012. And you go and you look at the adjusted close. Let's suppose this is some date in 2010. That value, that adjusted close value, will be different if you gather data from, say, 2015. So if you go to Yahoo and get today's adjusted close, there will certainly, for most stocks, there will be dividends and splits that have occurred since 2012. And so this adjusted close price today in Yahoo's data will be different, most likely lower, than the adjusted close for that date if you had gathered it in 2012. I know it's a little bit tricky. The key point is for projects in this class, you need to use the data that's provided for the class. It was gathered as of 2012. If you go to Yahoo and get new data, you're going to get different answers for the projects. So just keep that in mind. One of the things we do in this class is to simulate strategies that we might develop. We roll back time and pretend that we traded on certain dates according to certain signals, and we see what the result of our strategy might have been. Now, to do that, you have to start with some universe of stocks. One of the most common universes is the S&P 500. When you simulate your trading, you roll back time and you look at that universe of stocks. You apply your algorithm to choose which stocks you might buy. A very common mistake that people make is that they look at the membership of that universe as of today. Then they go back in time and they use that list of stocks for their strategy. So let's suppose we go back in time, we take the current list of the S&P 500 and we run our strategy, and our strategy is just doing great. I'm going to call that the biased strategy. So why is it biased? Well, we're selecting from stocks way back here that we knew were existing over here. So there's a built-in bias that these stocks are going to do well because they weathered the storm here. Now consider, what if we used the S&P 500 as it was back in 2007? So a lot of the stocks from back then did just fine. They survived. But a lot didn't. 68 stocks from the S&P 500 died. They completely went away from 2007 to 2009. So if you applied the same strategy that appears to be so awesome, but you use the real members of the S&P 500 from back then, you're probably going to have a significantly lower performance. And the difference between these two is the bias. The lesson learned is to use survivor bias-free data. And that's available from a number of providers. It's not usually free, but it's not necessarily that expensive either. But if you do that, you'll avoid this sort of false optimism for a strategy that you develop. Okay, that's it for dealing with data. I hope you found the lesson useful, and we'll see you again soon. Bye-bye. We haven't stated these explicitly, but we've been operating under some assumptions. For technical analysis, we assume that there is information in historical price and volume data that we can discover and exploit in advance of the market. For fundamental analysis, we assume there is information in fundamental data, like earnings, that can be exploited and traded upon in advance of the market. The efficient markets hypothesis says we're wrong about both. The first ideas that eventually became the efficient markets hypothesis were postulated by Jules Regnault in 1863. Eugene Fama carried those ideas further in the 1960s, and it became his PhD thesis. Fama recently received the Nobel Prize, so we know those ideas were good. So what's the efficient markets hypothesis about? Let's start by looking at some of the assumptions that it makes. Probably the most important assumption is that there are a large number of investors interacting in the market for profit. So they have an incentive to find opportunities where the price of a stock is out of line with what its true value is. And because there are so many of these investors operating simultaneously, anytime a little bit of information comes out there, the price is going to move. Next assumption is that new information arrives randomly. So it arrives at random times, it arrives at random rates for different stocks, but it's constantly arriving, and investors are paying attention to that information, and therefore the prices are adjusting quickly. Finally, the efficient markets hypothesis assumes that the current price reflects all available information. In other words, all this information that's trickling in is acted upon by the investors. The price adjusts quickly to that information, and the current price reflects all information about that stock. There's a number of places information can come from. Let's step through a few of these, sort of from most public to least public. But even this is certainly not an exhaustive list. There's many other places we can get information. But let's step through them. Price volume. This is public, it's rapid, it's quick, everybody can see it. This is the basis of technical analysis. Fundamental data. This is reported quarterly, and everybody can see it as well. It's public, but it points more to the root of the value of the company than just the price volume. Exogenous data, it's a fancy name for a simple concept. It's just information about the world that affects the company. As an example, if we were looking at an airline stock, an exogenous piece of data that would affect the price of the airline stock is the price of oil. If the price of oil goes down, usually the price of the airline stock goes up because energy is the number one cost for airlines. A very important and secretive type of information relates to company insiders. So let's suppose you're a CEO and you know that this drug that you've invented is about to be improved. You might go buy shares of your stock because you think the price of your stock is going to go up because that drug is going to be approved. Now, depending on the circumstance, it may or may not be legal, but this reflects information that you have that people outside the company do not have. And so this insider information is probably the least accessible of all these types, of course, and of most other types of information as well. Now, each of these types of information has a relationship to the efficient markets hypothesis. In particular, there's 3 forms of the efficient markets hypothesis, and these types of information relate to each of these 3 forms. And we'll get into that in just a second. There are 3 versions of the efficient markets hypothesis that go from weak to strong, and we'll take a look at them each one at a time. The weak form of the EMH says that future prices cannot be predicted by analyzing previous prices. The idea here is that the current price reflects all information we might know, so just by looking at these historical prices, you can't predict what is going to happen next. Notice, however, that this does leave room potentially for fundamental analysis. The semi-strong version of the EMH suggests that prices adjust immediately to new public information. So, for instance, when companies have their quarterly reports that contain fundamental information, prices react immediately to that information. So if semi-strong is correct, that would seem to prohibit even fundamental analysis. There's one possibility left, though, one way that we might make money, and that is based on insider information. Well, the strong version of the EMH says we can't even make money on insider information. Prices reflect all information, public and private. So even if there's some secret information within the company that points to a higher price later, the price will go up in the face of that knowledge. So if the strong version of the EMH is true, it is essentially impossible to make money by holding a portfolio other than the market portfolio. So let's recap each one of these real quick. The weak form says that you can't predict future prices by looking at historical prices. It is silent on things like fundamentals or insider information. It's just about price. You can't profit by looking at historical price. Semi-strong says that public information such as quarterly reports cause the price to adjust quickly. The price adjusts rapidly to this new public information. So semi-strong essentially says that even fundamental analysis won't work. Finally, the strong version says that even insider information can't be leveraged to profit in the market. Consider the 3 forms of the efficient markets hypothesis: weak, semi-strong, and strong. which of these types of analyses or strategies would these corresponding versions of the EMH prohibit? So, for instance, if you think that the weak version of the efficient markets hypothesis prevents fundamental analysis from working, you would check the box there. Okay, have at it. The weak version prohibits us from profiting from technical analysis because the weak version says that you can't predict future prices from past prices. But the weak version doesn't say anything about fundamental or insider information. Semi-strong prohibits technical analysis, also fundamental, but it's silent on insider. And finally, the strong version says that you can't profit from any of those three types. Is the efficient markets hypothesis correct? Well, if it is, then a lot of what we're trying to do in this course is not possible. Namely, we can't beat the market using any of the strategies we might be looking at. Now, I think there is evidence that certain versions of the hypothesis are not correct. And there are a number of very successful hedge funds out there that would seem to indicate that you can make money in the market by investing in things other than just the market portfolio. I would say the strong version of the efficient markets hypothesis is the least solid. In other words, the strong version says that you can't even profit from insider information. The reason that I think that one is not true is because we have seen people make money from insider information. Some of them have gone to jail, but clearly it's a method that can provide profit even though it might be illegal. This is an interesting data set that seems to refute the semi-strong version of the efficient markets hypothesis as well. It's a little bit complex, so I'll step through it carefully. So let's look at the blue dots. Each dot here represents the PE ratio on a particular date. So, for instance, this stock had a PE ratio of 20. That's price to earnings. That's the horizontal component of its location. The vertical location is how much money did it make in terms of price over 20 years. So, for instance, this stock had a price-earnings ratio of 20, and it made about 4% annualized returns. As we go down this way, the PE ratio is lower. So lower numbers for PE ratio are better. You know, if you think about it, price divided by earnings, if it's a lower price and has higher earnings, you'll get a lower number. So presumably lower values this way indicate higher value for a stock. And each group of colors represents different decade when the analysis was done. So, for instance, this dark blue was an analysis based on what the PE ratios of stocks were in 1890 and to 1910, and all the way up to the red, which was 1970 through 1985. Now, for all of these decades, we saw that at the beginning of the corresponding time period, low PE ratios corresponded with higher returns. So this shows that price-earnings ratios are very predictive across many, many decades of future returns. And that tends to refute the semi-strong version of the EMH. Okay, that's it for the efficient markets hypothesis. I will see you again soon. Bye-bye. You're probably familiar with Warren Buffett. He's one of the most successful investors ever. He's made a number of insightful comments over the years, many of which relate to this class. One of my favorites is, "Only when the tide goes out do you discover who's been swimming naked." That's not the one for this lesson, though. The one for this lesson is, wide diversification is only necessary when investors do not know what they're doing. Mr. Buffett is talking about two things: investor skill and breadth, or the number of investments. This lesson is about how investment performance relates to those two factors. In the 1980s, Richard Grinold was seeking a method of relating performance, skill, and breadth in investing. So for instance, you might be a very skilled investor, meaning that you can pick stocks well, but you might not have many opportunities or breadth to exercise that skill. So Grinold felt that there must be some equation whereby we could combine skill and breadth to create an estimate of performance. He developed a relationship he called the fundamental law of active portfolio management. I'm going to state it here at the beginning of the lesson and then spend the rest of the lesson trying to justify it and show you why it makes sense. And here's his expression. Performance is equal to skill times the square root of breadth. So we need some measure of skill and some measure of breadth. So if you want to improve your performance, you can improve skill, or you can find more and more applications or methods or opportunities for applying that skill. So as an example, breadth might relate to how many stocks you invest in, and skill relates to your skill at choosing them. So again, you can invest either in improving your skill or in improving your breadth. So performance is summarized in something called information ratio, which is very much like the Sharpe ratio that we've discussed before, but it refers to the Sharpe ratio of excess returns. In other words, the manner in which the portfolio manager is exceeding the market's performance. Skill is summarized in something called information coefficient, and breadth is just how many trading opportunities we have. Okay, so we'll expand on this more and more as we go through the lesson. Now we're going to explore these ideas in a thought experiment called the coin flipping casino. So instead of buying and selling stocks, we're going to flip coins, and we're going to bet on the outcome of whether those coins come up heads or tails. So that's analogous to a single investment in a stock or a single trade in a stock where you buy it and hold it, and either you make money or you lose money. Well, we're going to flip a coin and either make money or lose money. Now the coin is biased. In other words, we have information about this coin, and we know that it's more likely to come up heads than tails. And in fact, that probability is about 0.51 that it'll come up heads. So that's our edge. That's like our alpha when investing in stocks. And the uncertainty of the outcome is like beta in stock investing. Here's how betting works. So you can bet on any particular coin flip. You can bet in coins. If you win, in other words, it comes up heads, you now have 2 in coins. If you lose, they take your money. So this is called an even money bet. So on each outcome, you either make in coins or you lose in coins. Here's how the casino works. There are 1,000 betting tables, each with their own biased coin, and you have 1,000 tokens. So you can choose to bet however you like. In other words, you can put 10 tokens on each of 100 tables. You could put 1,000 tokens on one table. You could put 1 token on all the tables. Once you've distributed all your tokens, which represent your bets, the coins are all flipped at once. In other words, the game runs in parallel, and you, for each bet that you made, you either get your winnings or they take the chips that you bet. So now that we've set up this environment for us to experiment with, I want you to think a little bit about it and think about how would you allocate these tokens? Is it better to bet all your tokens on just one coin flip, or is it better to bet on multiple coin flips at once? So I want you to consider these 2 scenarios, 2 different ways to bet. In one case, you put all of your 1,000 tokens on a single table and 0 of your tokens on the other 999. So that's one way you might bet. And the outcome is going to depend on only what happens on the coin that's flipped on that single table. Another approach is to put 1 token on each of the 1,000 tables, and then all the coins are flipped in parallel, and you get your reward or loss that way. Which one of these is better, or is it the case that both of these are equivalent? Now, it would be fair for you to object and say, well, Professor Balch, what do you mean by better? I'll get on to that, but I think it's pretty clear actually that this is the best bet, and we'll spend some time explaining why. But the big picture is this bet is very, very risky. There's a 49% chance you'll lose all your money with a single flip of the coin. Whereas in this case, your coins are distributed over 1,000 individual small bets, and there's very little chance you'll lose all your money. And furthermore, the expected return for each of these bets is the same. It's just that this one has much lower risk. To figure out which of these different scenarios is best, we need to consider reward and risk. Let's start here first with reward. So when we talk about reward in this situation, we're talking about our expected return. So in the single bet case where we bet 1,000 chips at once, our expected return is the chance that we'll win the bet times the return we'd get, plus the chance that we would lose the bet times what we would lose. So the chance that we're going to win is 0.51. Remember, it's a biased coin. And we have the opportunity to win 1,000 tokens or $1,000. The chance that we'll lose is 0.49 or 49%, and if we lose, we would lose $1,000. So if you multiply this all out and add it up, you end up seeing that our expected return is $20. I'd like for you now to figure out what's our expected return, or what's the reward, in the multi-bet case where we bet 1,000 individual chips on 1,000 different tables, and all those coins are flipped at once. All biased coins with a 51% chance of winning for us. What's our expected return in that case? So we make a bunch of individual bets. Each one has the same chances as this one up here, except each one of those individual bets only provides a loss of $1 or a gain of $1. So each of our individual bets has this 0.51 chance of winning $1 and 0.49 chance of losing $1. And we just have 1,000 of those. So if you work out the numbers, it turns out that this works out to be 0.02, and we multiply it by 1,000 and we get $20. So what's remarkable, or at least interesting, is that for both of these ways of betting, our expected return is exactly the same. So the reward side of this determining, which is better, is showing us that it's the same. So why should I say that this multi-bet approach is better? Well, it turns out that that's all about the risk. So let's look at the risk now. There's a number of ways that we might consider risk in this scenario. Let's look at first this idea of what's the chance that you might lose it all. So you put out your bets on the 1,000 tables, the coins are flipped. In that event, what's the chance you lose all of your money? In the single bet case, where you put all of your money on a single table and the outcome is determined by the flip of a single coin, remember, even though it's biased in your favor, there still is a 49% chance it'll come out against you. So if you put all your money on a single table for one coin, there's a 49% chance that you'll lose all of it. That's pretty high. I mean, consider that in the context of, would you put your savings account on a single bet like that? Now, I want you to think a little bit. Consider the multi-bet case where we put one token on each of the 1,000 tables. So there's 1,000 coin flips, and our return is determined by the result of all those individual 1,000 coin flips. What is the chance that we would lose it all in that case? Well, the answer to that is that it's the probability that we lose on the first table times the probability that we lose on the second table times the probability we lose on the third. And as you can see, we do this for all of the 1,000 tables and multiply those probabilities all together, and that's the probability we would lose everything in that multi-bet scenario. That is a very, very small number. It's 0.49 to the 1,000th power. How small is it? Let's try and calculate it on a calculator. So it's 0.49 raised to the 1,000th power. Let's see how small that is. It's so small, it's not even a number. That's how small it is. Okay, let's look at another way to evaluate risk. Another way that we can look at risk in this thought experiment is to consider the standard deviation of all those individual bets. So again, consider we have 1,000 different betting tables out there, and we have the opportunity to allocate our bets however we like. We could put 200 tokens on one table, 5 on another, and so on. We're looking at the two extreme cases here, of course. But in any case, what is the standard deviation of the results of all those individual bets? So we're going to look at standard deviation after the fact. In other words, we're going to assume we bet already and we're looking at the outcome. So if we have 1 token per table, we might have a loss of 1 token on one table, a gain on another loss, and a gain, and so on, all the way across our 1,000 tables. Now, we don't actually have to spend much time doing the math here. It turns out that the standard deviation for this case is pretty easy to calculate, because for each table the result is either -1 or 1, and it turns out that the standard deviation in this case is easily calculated as 1.0. So it doesn't matter what the particular outcome turns out to be. We know we're either going to lose 1 or gain 1 in every single table, and so our expected standard deviation there is 1. The outcome for the second scenario, where we make 1 bet with 1,000 tokens and then essentially 0 bets on the other tables, turns out a little bit differently. So on this first table where we bet 1,000 tokens, we either win 1,000 or we lose 1,000. And on all the other tables, the outcome is exactly 0. Same for this case where we lost on that first one. So again, we bet on one table 1,000 tokens, and we bet 0 tokens on the other 999. Reasoning it out this way enables us to calculate the standard deviation. Whichever way it goes, whether we win or lose, the standard deviation on this event is the same, and the answer is 31.62. Key point here is standard deviation, or risk, is much, much larger, well, as you can see, about 31 times larger when we make that single bet on one table and no bets on the other tables. Now we're going to bring all these components together and consider risk-adjusted reward, and this is just like the Sharpe ratio that we've looked at in other contexts. In the single bet case, we can calculate this ratio easily like this. So remember, our reward, or our expected return, was $20, and our risk was $31.62. So if we divide this out, we get our Sharpe ratio, or just the adjusted risk-reward ratio for this scenario, and it turns out to be 0.63. I'd like now for you to fill in the numbers for the multi-bet case. In other words, the case where we put 1 token on each of the 1,000 tables and then get our return from that single event. So the reward or the return is the same, but remember the standard deviation or the risk was very much smaller. So we end up with a much larger ratio in the multi-bet case. So the take-home message here is, even though we have the same expected return, we can have much lower risk and thus a much higher risk-adjusted reward if we have many, many bets, 1,000 bets instead of just a single bet. So let's step back a moment and look at these results for these two extremes. So we had this one extreme where we bet all 1,000 chips on a single coin flip, and another where we bet 1 chip on each of 1,000 coin flips. Now the risk-adjusted reward, or the Sharpe ratio, for the single bet was 0.63. In other words, if we bet all 1,000 chips on a single flip of the coin, our Sharpe ratio is 0.63. So let's call this SR single. Now the Sharpe ratio, if we bet 1,000 times, in other words 1 chip on each of 1,000 tables, turns out to be 20. So what's the relationship between these two? Of course, 20 is about 40 times bigger than 0.63, but there's something more interesting there, and it turns out that it's this. So if we take the single bet case and multiply it by the square root of 1,000, we get the Sharpe ratio of our multi-bet scenario, where we bet 1,000 at once. So isn't that curious? So it turns out that in general, if you carry this scenario out to more examples, that if you split your bets evenly across multiple tables, this relationship will hold. In other words, the Sharpe ratio for the single bet, 1,000 chips on one table, is sort of our base case, and as we spread it out over more and more tables, the Sharpe ratio improves by the square root of that number of bets. And this relation is exactly like the fundamental law of active portfolio management, namely our overall performance is related to the skill in the case of making a single pick times the square root of the number of picks that we're able to make. So our coin flip casino has helped to show us how we can derive an equation like this for betting, which is what buying stocks really is, and to show that you can improve things either by having more skill. In the case of coin flips, skill is how biased is the coin. In the case of investing, it's how good are you at predicting the future return of a stock. Or you can improve your performance by increasing your breadth, but you only get to improve it by the square root of your breadth. Consider now the results of this thought experiment. Our casino enabled us to allocate our 1,000 tokens to 1,000 tables. We looked at two extreme cases. One where we put a small bet on all 1,000 tables, and another where we put all our money on one table. We saw that the expected return was the same in both cases, about $20. But the risk was substantially higher for the single bet case. This was true for both types of risk that we looked at: risk to lose everything and risk as standard deviation. When we consider risk and reward together, we come away with three lessons. 1, higher alpha generates a higher Sharpe ratio. 2, more execution opportunities provides a higher Sharpe ratio. And 3, Sharpe ratio grows as the square root of breadth. Let's consider now the real world, and in particular hedge funds. So let's consider two real world funds. One is Rentech, or Renaissance Technologies. It was founded by Jim Simons, a math and computer science professor, and he's had tremendous performance over the last several decades. And Warren Buffett, who runs Berkshire Hathaway. Both of these funds over the years have produced similar returns. But on the one hand, Warren Buffett holds maybe 120 stocks, and he doesn't trade much, he just holds them. Renaissance Technology trades maybe 100,000 times per day. Can a single theory relate these two? Can it account for the vastly, widely differing numbers of trades per year? And can it relate the fact that they have similar performance and maybe different levels of skill? How does that all work together? Well, yes, there is a theory that can relate them. It's the fundamental law of active portfolio management, and I'm going to show it to you in just a moment. Before I introduce the fundamental law, I've got to define a few terms. Let's start with information ratio. So recall, the return on our portfolio for a particular day is equal to the market component of the return, which is beta for that portfolio, times the return on the market for that day, plus this residual return. Another way to look at that is to say that this component of the return is due to the market, and this component is due to the skill of the fund manager. Remember, alpha is about skill. Now we want to focus on the skill component. In other words, what is the fund manager bringing to the table? And we can calculate the Sharpe ratio, essentially, of this component, just like we can calculate the Sharpe ratio of an entire portfolio. But we can focus on this skill component, and essentially the Sharpe ratio of this skill component is the information ratio. It works like this. So the information ratio is the mean of all of the alpha components divided by the standard deviation of the alpha components. So this is our reward component, that's our risk component. And by the way, this is calculated by looking back historically at the daily values of alpha, and we take the mean and the standard deviation of them over time. You can find these by finding beta for the portfolio, calculating what the market return component was for each day, and then the difference is this residual or skill. So that's how you can compute historically the value of this information ratio. Now, by the way, this information ratio applies in many different cases, not just in this fundamental law case. people use information ratio as a measure of manager performance all the time. It's fair to say that information ratio is essentially a Sharpe ratio of excess return, this part that's due to skill. IC, or the information coefficient, is just the correlation of the manager's forecasts to actual returns. So for instance, if she made a forecast on IBM that it would go up 1% and it went up 0.5%, well, that's a positive correlation. This value can range from 0, where the correlation is not present, to 1, where it's very, very strong. Finally, BR, or breadth, represents the number of trading opportunities per year. So for example, if you're Warren Buffett and you hold 120 stocks and you just hold them all year, that's 120 trading opportunities. If, say, you're Jim Simons and you trade 100,000 times per day, you multiply that times the number of trading days in a year, well, it turns out to be a very large number. Key thing is, even if it's just a portfolio where you buy and hold, you count the number of positions in that portfolio as the number of trading opportunities, because this is oriented around an annual measure. Now that we've introduced these factors and defined them, we're now able to describe the fundamental law as expressed by Richard Grinold. And it's simple. It's just this. He was able to show mathematically that information ratio is equal to information coefficient times the square root of breadth. I'm going to just present it without proof here and encourage you to go look at Grinold's book if you're interested for more detail. So performance of the manager or the fund is due to the skill at making predictions times the square root of breadth. So that means, for instance, that yes, you may be very skilled, but you've got to have opportunities to invest in order to operationalize your skill. Now, if you want to improve your performance, you can either focus on improving your skill or focus on improving your breadth. Sometimes it turns out that it's a lot easier to increase breadth by finding additional stocks that you might look at or additional markets. You might have some commodity trading strategy that works great. You can increase your breadth by looking at additional commodities. However, the strength of this increase, in other words, as you increase breadth, the overall performance only increases as the square root of that breadth. So it tapers off after some amount of time. It turns out, though, that it's very, very hard to improve your skill. So that is why, for instance, folks often focus on the breadth component of this equation. Let's get back to that original question that motivated some of this, which is how can we relate the performance of Renaissance Technologies, or Jim Simons, versus Warren Buffett? And the quiz here is for you to use the fundamental law to see if you can relate the two. Okay, so for this problem, assume that both Simons and Buffett have the same information ratio. I'm making that up. I don't know for sure that they do, but this is just a simplification for this problem. Assume that Simons' algorithms are only 1,000th as smart as Buffett. So that's another way of saying that their information coefficient is 1/1000th the value of Buffett. Also assume that Buffett trades 120 times per year. Given that, how many trades must Simons execute in order to maintain the information ratio at the same level as Buffett? The answer is 120 million. So if Buffett trades only 120 times per year, Simons has to trade 120 million times. So here's how I arrived at that. We know that their information ratios are the same, so we just set the equation equal to each other, one for Simons and one for Buffett. So the information coefficient for Buffett times square root of 120, this is Buffett's information ratio. Now this is Simons' information ratio. It's his information coefficient times the square root of x, which is what we're trying to find. Now, first thing we can do is replace ICS with what we know that it's 1/1000th of Buffett's. Now we can multiply both sides by 1,000 and divide both sides by Buffett's IC, and we get this. And now we just square both sides, and we're left with x. or 120 million. Okay, that's it for the fundamental law of active portfolio management. I'll see you again soon. Thanks. Suppose you have a set of stocks that you've determined are good investments. How much of your portfolio should you invest in each? There are many potential answers to that question. In this lesson, we take a look at the approach called mean variance optimization or portfolio optimization. The specific question we're looking to answer is this: given a set of equities and a target return, find an allocation to each equity that minimizes risk. If we're going to find a portfolio or an allocation of assets to different stocks that minimizes risk, we have to pause for a moment and consider what is risk. Let's consider two stocks, XYZ here, that's gone up about 10%, but as you can see, it's been very volatile. Here's the historical price of another stock, ABC. It also went up 10% over the same time period, but as you can see, it was less volatile. So it's this volatility that we use as a measure of risk, and that is simply the standard deviation of historical daily returns. Again, in this case, risk is measured as volatility or standard deviation of historical daily returns. That's the standard view of risk in most finance texts. There are other ways to view risk that we touch upon here and there through this course, but the key is standard deviation of daily returns. Now, as you've probably heard over and over and over again, there's no reward without risk, and we often want to consider multiple stocks together and evaluate their risk versus return. So one way we can do that is plot them on a scatter plot where each dot here represents one stock. So risk is along this axis, return is along this axis. So for instance, this stock here has higher risk but about the same return as this stock. And then for comparison, this stock here has shown historically about the same risk as this stock, but it's got a much higher return. Now we can build a portfolio by combining multiple assets like the various stocks I've got plotted here and weighting each asset by a particular weight that represents its allocation within the portfolio. So each stock has a weight, and when combined all together, we end up with a portfolio that has properties of each of the stocks. It's typically got a risk somewhere in the middle there and a return somewhere in the middle. I'd like you to consider these three portfolios. Now, each of the green dots represents an asset that's in the portfolio, and it's on this risk versus reward scatter plot. We've indicated the weights of the assets by the size of the dots. So for instance, this portfolio has most of its assets in these two equities, whereas this one has most of its assets in these three. Now over here in this right column, I indicate with a big orange circle the risk return level for several different portfolios. And what I want you to do is match these resulting portfolios to these weights. So give it a go and I'll come back and show you the answer. Okay, so in this portfolio we're emphasizing risky assets, and our portfolio ought to be somewhere around in here once we combine them. And of these three, this one seems to match the best, so the answer here is B. If we look at this one, we're emphasizing less risky assets, so we should expect the portfolio to have a value at low risk. And of the three choices, A looks like the best match. And this is the only one left, but note that it's essentially a combination mostly of low return and low risk and high risk stocks. And so it's somewhere in between, and the answer there is C. So for quite a long time, people built portfolios this way. They would look at a bunch of assets, essentially equally weight them, and end up with a portfolio that behaves somewhat in between. Now, if you wanted a low-risk portfolio, you should focus on assets that are low risk out here. If you wanted, for instance, high return, you should focus on assets over here. And in both those cases, you would end up with a portfolio, say here, or a portfolio, say, here. Now, can we do better? In other words, is it possible to get portfolios over here? So can we have a portfolio here that has a return similar to these assets over here, but risk similar to these assets over here? Indeed we can, and it's due to a man named Harry Markowitz, who won the Nobel Prize for his insight. What he discovered, and what people had been overlooking, was the relationship between stocks in terms of covariance. So the resulting performance of a portfolio, especially in terms of risk, is not just a factor or a blend of the various risks, but it has to do with how they interact day to day. So indeed, if we pick the right stocks in the right proportions, we can get a portfolio that performs over here that in fact can have lower risk than any of the individual assets. Now I'll show you how to do that in just a moment. Before I do that, I want to mention, though, one other thing about Harry Markowitz. Up until the time of his discovery, most people viewed bonds as the lowest risk asset. In other words, if you wanted low risk, you should use bonds only. Markowitz showed that a blend of stocks and bonds is actually lower risk than either one of those by themselves. And I'll show you how that makes sense in a moment. So to illustrate the importance of covariance, we're going to take a look at a couple different stocks here. These are pretend, of course. So here's one, ABC. It's gone up 10%. Here's another stock, GHI. It's also gone up 10%. But notice it tends to zig when ABC zags. So it's not going in lockstep with ABC. Finally, here's our last stock that we'll take a look at, DEF. Note how it goes almost in lockstep with ABC. So three stocks, two that move together very similarly and one that moves opposite them sometimes, yet they've all provided about 10% return. What is the best portfolio we can build by combining these three different stocks? So let's consider their covariance, or how they move together, for a moment. So ABC and DEF move very similarly. And if we were to measure their covariance, and this is the covariance of daily returns, which if you're just looking at one stock versus another, that's the same as the correlation coefficient of their daily returns. So 0.9 means that they move very closely to one another. Now, if we were to look at the covariance of daily returns of ABC and GHI, we would find that they actually have a negative correlation. In other words, when ABC goes up, GHI tends to go down. So they actually have a negative correlation, or a negative covariance, whereas ABC and DEF have a positive covariance. Again now, what's the best way to blend these together? So let's consider a couple of different portfolios which are just weightings on these different assets. Let's look first at one that is 50% ABC and 50% DEF. So what's that one going to look like? Well, they both move very similarly, so this portfolio is going to track the two of them together. So the performance of this portfolio is going to look something like this. So that's fine. It ends up returning 10%, just like the two major assets that it holds. But there's no real advantage in blending these two assets because it just has the same volatility as each one of them by themselves. So what if we try something a little bit different? What if we take 25% of ABC, 25% of DEF, so that's going to give us this same motion that we saw here when we combined those two. But we put the rest of it in GHI. So now we're combining an anti-correlated asset with these other two. So what's this portfolio going to look like? Well, it's going to be a nice blend of them with very low volatility, because when one zigs, the other zags. So this portfolio will also have a 10% return, but look how smooth it is. And that's because we're blending anti-correlated assets together. So we get the same return, but lower volatility than any asset by itself. So all these assets by themselves had significant volatility, but when we put them together, we reduce volatility significantly. That's the magic of what Markowitz provided, and we'll look a little bit more at that in just a moment. What Markowitz added to the game was this consideration of variance and covariance between individual stocks, and the recognition that you want to blend those together that have anti-correlation. So you can have a much lower risk portfolio if you combine assets that are anti-correlated, or anti-varianced, if that is a word, because when one moves up, the other moves down, they cancel each other out, and you have much less volatility. Now, of course, you want overall these assets to, in general, move up together. So often what we're looking for is anti-correlation in the short term and positive correlation in a longer term. But out of this work grew a number of algorithms, one of the key ones being mean variance optimization, which is a way of taking a potential set of assets and figuring out how they should be blended together by looking at their covariance, among other things. So let's consider this group of assets here and how we might combine them or allocate funds to them to provide a good portfolio. One thing I didn't point out before that I want to mention now is that generally the higher return stocks or assets, whatever they might be, tend to also be the highest risk. So as we roll down the risk, we tend to also look at lower return. Now, again, how do we combine these into a good portfolio? Here's what goes into a mean variance optimizer. These are the factors that it considers. So for each stock, you have to provide an expected return. In other words, what do we think in the future it's going to provide in terms of return? You also provide volatility and covariance. Volatility is simply historically how volatile has each one of these assets been. Covariance is a matrix which shows between each asset and every other asset what is the correlation of daily returns. So it takes all of these into account when it is searching for the right weighting for each of these stocks in a portfolio. So the last and perhaps one of the most important inputs to this is the target return. We can target a return anywhere from the max return asset to the min return asset, and then anything else between those, of course, we can accomplish by blending. So let's suppose this is the level of our target return. So I'll just put a dotted line here so we can mark that for later. So the output of an optimizer is a set of weights, one weight for each asset, that provides the target return but minimizes risk. So in the end, we're looking for a portfolio that's out here. In other words, it's got risk that's even lower than any of the individual assets, but it meets the target return. And this is possible because we consider covariance. If we're only looking at individual risk, we wouldn't be able to find the right blend that would bring us out here. Now that's it for optimization and the insights from Markowitz. But there's one more thing to look at with regard to optimizers that I'm going to show you next. There's one last topic I wanted to talk about with regard to portfolio optimizers and modern portfolio theory. Consider these assets and also recognize that for any particular return level, there is an optimal portfolio. So let's suppose we pick this return level and that this is the optimal portfolio. In other words, this portfolio reflects weightings of all these assets that provides the lowest risk for this particular return. Now, we can compute this for all the potential returns from the minimum return stock here up to the maximum. And if we did that for all of them, in fact, there's an infinite number of them, so we couldn't really do it for all of them, you get a line. So our maximum return portfolio is up here, and it would consist entirely of that one asset. But as we bring the return down, we find a number of other portfolios all the way down to here. A couple different things to observe that are interesting. One is as you reduce the return, sometimes this curve comes back in this direction, indicating that actually the risk is increasing as we reduce the return. So for the most part, people don't want those sorts of portfolios. In other words, who wants a lower returning portfolio with more risk? So we typically look only at portfolios above this line. As you might have guessed, the name of this line is the efficient frontier. So what does that mean, the efficient frontier? Well, it means that there are essentially no portfolios out here, and that any portfolio that's on this side of the frontier, it's suboptimal in some way. So for instance, if you had a portfolio here, you are assuming this much risk for a lower return than you could have if you were up here on the frontier. Or if you were targeting this much return, you could be over here with regard to risk. So any portfolio inside here is not efficient because it's either higher risk or lower return than it could be if we were on the efficient frontier. One last thing to mention about the efficient frontier is if you draw a tangent line from the origin to the frontier, where it hits is the max Sharpe ratio portfolio for all of these assets. In practice, the efficient frontier isn't used for that much other than as a theoretical device, but people do often like to plot the efficient frontier so they can see where their portfolio is in relation to the assets that they're using and where they could be in terms of efficiency. Okay, that is all. I will see you online soon. Thank you very much.